Okay, so our first speaker is Anthony Newman from Allica Bank. Anthony's first time presenting with us. And the reason it's his first time presenting is that Allica have recently launched a brand new product to market, which if any of you are involved in this sector will know how invaluable this is actually going to be. If any of you come across leads from time to time, this could be absolutely fantastic for you. So you should receive this by email from us this morning. It's the Allica Commercial Mortgages Care Homes leaflet. That will be on a PDF in your inbox. Check your spam if you haven't received it, because they have all gone out. Only 2 have bounced and we've resent them. A little bit about Anthony, first of all, is the healthcare specialist at Allica Bank and has been working for the past 12 years in a mixture of high street, mid-corporate and small challenger banks. He's specialised in the care sector for the majority of his career, having supported various sectors in care, including elderly care, children, adult learning disability care, hospitals and dentists. And I love this, the interesting fact, he's qualified fencing coach. Never come across one of those before, and has competed nationally when he was younger and fitter. So there you go. So Anthony, it's over to you. I will see you in about 15 minutes. The controls with you.
Fantastic, thank you. Good morning, everyone. Thank you for obviously taking time out this morning just to join us, just to discuss a bit more about elderly care mortgages. Just a quick overview of what we'll be covering today. So we'll be firstly just talking a little bit about Allica and the care market, our appetite within the sector, the sort of terms that we offer, and then probably finish on the most interesting bit, which is some case studies that cases that we've offered and completed on, just to give you a flavour of the types of transactions that we are seeing in the elderly care space. So first of all, just who we are. Allica Bank was founded just over 2 years ago, founded by a private equity fund, Warwick Capital, on the premise of providing a commercial bank alternative to the high street. The bank was built on the premise of 3 core values of straightforward, integrity, and collaborate. And last year we acquired AIB's SME loan book with the support of further investment from Allica Capital Management, evidencing our continued support for the SME sector. In terms of the healthcare piece, we launched that in the end of September last year in the elderly care space. And so we've been running that now for a little over 5 months. And it's been a fantastic feedback so far from the market. I think there's been a lot of pullback from the high streets with it, so it's been great to support brokers with providing a new sort of lending pathway there. In terms of our support and why we've come into the market, the SME care home market has been underserved. High street banks are highly selective on who they support, often favouring sort of larger operators or groups. Or they've pulled back from the market altogether. SME customers and new entrants have therefore really struggled to find appropriate funding. Also, we really respond well to the feedback from all of our brokers, and the sort of communications from them was that there was strong demand from entrepreneurs and investors who see care as an attractive sector backed by positive drivers. You know, an aging population, the shortfall in supply, the fact that the sort of sector has been brought to that forefront of political agenda by COVID, with the focus on the need to support, and also that it is relatively insulated from the likes of financial recessions and pandemics, with support provided at a governmental level to support that. Businesses are also highly regulated by the Care Quality Commission, which is the monitors and regulates all care homes, and therefore they are often very well managed, and buyers have a clearer understanding of the business that they are acquiring, and this is a positive for lenders as well. So just a quick snapshot of the elderly care market. The elderly residential and nursing care market is worth over 16 billion. There are around 11,000 elderly care homes across the UK, of which about 20% are run by large groups such as Four Seasons, Barchester and HC1, with the remaining 80% run by SME-type independent operators and small groups. Elderly care is supported by the strong market demands for the care homes. So as I previously mentioned, the aging population, with people just living longer and with multiple illnesses. So people over the age of 85 are forecast to double in the next 25 years from 1.4 million to 3.5 million. And at present, there are fewer new beds being built than there are exiting the market, with an anticipated shortfall of around 100,000 beds by 2030, evidencing a need for new entrants and an opportunity for those to get into the market. And again, heavily regulated by the Care Quality Commission, who assess care, staffing, safety standards across the sector, and also provide regularly monitoring to elderly care homes. So just a little bit about our appetite. So at the moment, we are looking at elderly care homes, including residential, nursing and dementia care. At present, we have no other specialised care or primary care offering at the moment. It is something that we probably will explore over time. We are looking at a combination of either experienced operators with established management and operational teams, as well as first-time buyers, which is something that not every lender will entertain. And that is probably down to if we can get comfortable with the fact that the registered manager for the care home is staying in place and the staff are all staying in place and they have that sort of long track record within that home. Care experience is preferred, but we recognise that to support first-time buyers coming into the market, that isn't always guaranteed. And so we do look at it on a case-by-case basis. In terms of the asset profile, we look at a minimum of 20 beds with a preference of ensuite and single occupancy, unless there's a positive reason for it not to be the case. We look at purpose-built care homes as well as older conversions, strong local demographics, good high levels of demand. Competition may be there, but it's mitigated by the fact that they've still got strong occupancy and are bringing in residents. A CQC rating of good. Minimum of 2 years trading, so we won't look at startups, and a minimum occupancy of the last 12 months of 85%, although we do recognise the fact that if, with COVID impact, that might not be the case, and we will always take a view. And in terms of loan profile, we look at owner-occupied only. OpCo/PropCo is permitted, and with appropriate security and leases in place, and it's often a common thing we see in this market space. We look at for reasons of available for purchase, refinance and capital raising. And at present, we don't look at development finance or finance that require any sort of stage drawdowns. So just a quick overview of our terms. So again, we lend to limited companies, LLPs, partnerships and sole traders. Often these are sort of new cos established to acquire the shares of the company. Loan size currently is between £500,000 to £5 million, subject to a maximum leverage against EBITDA of 5 times. Loan to values, a combination of maximum 70% of MV1, and then you can see at the bottom of the table there that there are sort of various baskets around vacant possession value. So we can lend up to 120% of vacant possession value, and then that dictates the term and the margin around that. In terms of term, we can do between 5 to 25 years for purpose-built care homes. And we do capital and interest repayments, but we will consider capital repayment holidays, again, on a case-by-case basis. Base rate is, again, at the moment we're doing base rate only. Future products will be coming out over the next few months. Looking at debt service cover of a minimum of 150%. Calculated using cash flow available for debt service rather than EBITDA. Security packages tend to be fairly standard, so first legal charge over the property, debentures, company guarantees, and a potential for a PG. Early repayment charges 3% for the first 5 years, and then overpayments of up to 10% allowed per annum. And so moving on to the case studies, I feel that this will probably give you guys a very good overview of what sort of we're seeing in the market and the terms that we're offering against those. So the first one is so just a bit of background on this. He was an operator who acquired his first care home in 2017 and was now looking to refinance and capital raise against this home and to acquire a further 2 care homes. Each home was about 30 beds. All of them were converted homes. 2 were performing from an occupancy perspective, with 1 having suffered a small COVID impact. We support a case based on the track record of the operator and good quality conversion homes. This has actually had a revision post-valuation where it came out, it was expected to be around 95% of the VP, and it came out at 117%, but we still supported the case, given the strength of the operator, the cash support, and the quality of the business. The next case is, and it was an experienced operator who has an established care group of 6 care homes with 2 other shareholders, but he was looking to come out of that on his own and build his own, sort of expand his group, but separately from the other 2 shareholders. So this was to represent the sort of first home in a new group. The asset was part of a larger care organisation, a national care group, looking to dispose of the assets. It was a 50-bed purpose-built, older purpose-built home, which had suffered some COVID impact, with occupancy kept lower than normal to ensure risk controls managed. We were comfortable with the experience of the operator and the track record in turning around the homes such as this. So we were able to do this on a combination of 59% of MV1 and 90% of MV3 over 20 years, and 2% fee to the broker. And on to the next case. This one was for a first-time buyer. So we were approached by a broker to support first-time buyer. In this case, they had no care experience. However, the case demonstrated a number of strengths. The client had been looking for to get into the care home sector for a number of years. He had been working for 4 years with a care operator to find the right home. So this sort of represented that this wasn't a whim. This was, a dedicated effort on his part to get into the sector. He also had significant money to invest into the home. The home he chose was incredibly well run, with a very strong management team supporting it. And the client had a close friend who was an established care operator. He ran 5 homes himself, and he was very willing to support the client. He was willing to come in as a director and a shareholder if needs be. And again, with that one, we bought into all of that, and we were comfortable to lend on a sort of 90% of vacant possession over 20 years at 4% margin, and again, a 2% fee to the broker. Number 4, we've got a more interesting case here where we have, it was an existing operator who was looking to acquire 2 care homes. One was actually a requires improvement, which can pose an issue to some lenders in the market. They're not very keen on requires improvement care homes. We got comfortable with this because the existing operator had acquired his first 2 care homes in 2019. He subsequently had reviews of these done, and they've both come out CQC good. We bought into what he had done in his strategy of implementations of electronic care plans, of investment into staff and training of staff, that he would be able to go into this business and really turn around that requires improvement into a good. And so that's where we got comfortable with it, and we were able to do, in the end, we pushed it to, again, 90% of VP on a 20-year term, capital interest, again, and a 2% fee, of which 50% to the broker. And then the final case we've got is for a relatively new operator who was looking to acquire his second home. He'd bought a home in 2020 and was looking to acquire this at the tail end of last year. I think that was presenting challenges around funding, with banks looking to see him having bedded in more since he acquired it. But we really got comfortable with the fact that since he had taken on this first home, he'd really managed it very well. It continued to receive a good rating. It had been rated since his ownership of it. The home was trading very well, and the target home was incredibly well performing. Had a strong management team that was long-standing and was committed to staying on. And I think based on that, we were comfortable in the customer acquiring that second home despite that short time frame. So in this case, we did 100% of the vacant possession, a loan of 2.9 million with 20-year term, but based on a 12-month capital repayment holiday and a 19-year capital and interest repayments, and again, a 2% fee, 50% to the broker. And that is it for me.
Anthony, thank you very much. Excuse me, coughing. I don't know where that came from. We've got unfortunately, got a load of fruit flies have infested the building.
Oh, no.
So I just swallowed one. They're back. They've decided that my office they're going to take up residency, so I need to switch on my exterminator thing again. So apologies for that, everyone. Come back on screen, Len coughing me guts up. Anthony, thank you very much. That incredibly interesting. One thing that struck me there straight away is, regardless of the location of the property, is the loan sizes. I mean, they are. I mean, anything Oldham for 820 grand. I mean, delegates, if it's a situation that you're not in the commercial market, but you've got contacts in the care home industry, or you want to make contacts in the care home industry by making a phone call, you could quite literally be generating business, passing it on to us, and generating 0.5% of the loan value. £1 million is £5,000 just for making a phone call. Because one thing that's happened in the care home sector, as Anthony said right at the start, is you try getting a mortgage on a care home over the last 3 years, it has been a nightmare, absolute nightmare. We had one woman that we said to her, just wait until the market comes back, And then the market came back. We found out she'd actually not paid her mortgage for 6 months in supporting the care home, so we couldn't place it anywhere. Someone else has placed it on a rate of over 10%, which we wouldn't offer. But it is a massive opportunity. It really is, because this has been massively underserved, this market, for quite some time. So, and also there's also a lot of companies out there who bought it during lockdown. There are people out there who bought these on bridges, expecting things to be fine by the end of 2020, and could still be sitting on those bridges at the moment with very little opportunity to get out of them. So again, get out your contacts book, pick up we don't have Yellow Pages anymore, do we? Get on Google and see what they're doing. Brief conversation could make you substantial amounts of money. It really could. Right, we don't have any questions from delegates, so I'm going to ask you the two pre-prepared questions, Anthony. So here we go. What are some of the key areas which need to be considered when looking at a care home transaction?
Yeah, I think I'm so prepared for this one, but it is a sector that requires a lot more sort of thought around the structure of the proposal in terms of the various things. So you've got your asset type, is it purpose-built or converted? Mostly just because it does dictate really what lender appetite is going to be. Your high street banks will tend to want larger bedded homes, probably more purpose-built or newer stock. Bed numbers as well, again, they're 40 to 50 beds is sort of your high street level. Your sort of secondary tier lenders will potentially lower, and as I say, Allica does do a minimum bed size of 20 beds. It also could be the minimum number of homes, where again you might have some lenders, high street. In my previous roles, it might be that it was a minimum for 3 homes or something, like that. Whereas Allica will look at a single asset transaction on this. So again, probably appealing to the SME market. Majority of lenders will require a CQC of good rating, whereas only sort of specialist non-bank lenders will look at RI, which again usually attracts a higher margin. But we are starting to see, ourselves are starting to look at RI rated homes under case by case basis, and some of us secretary to lenders are looking at it now as well. The experience of the operator definitely always plays a key. Some lenders have limited appetite first or no appetite for first-time buyers altogether, whereas others will look at care experience, and they will also look at the whole scenario. What is that support network there with that your customer coming in? Have they got family that's directly involved as a care operator, or do they have healthcare experience that have that kind of transferable skills? And I think the last one is just the management team that's being looked at within the care home. Has the registered manager only been there 6 months, or if they've only just been promoted? Is it a case of it's all very new and you're then trying to get a new operator to come in, because that's where sort of mistakes can happen. Often you're looking at wanting to see an experienced team that have been there for a number of years, have gone through a CQC inspection and had a good rating, which can really help. So I think those are all sort of the areas that need to be looked at when you're trying to submit something through.
Okay, your next question, or your final question actually, that you set yourself, was why are you seeing more and more brokers interested in getting into the care home sector?
Yeah, so I did touch upon it a little bit in the presentation, but I think it is a combination of the sort of market demands, especially over this pandemic. We've seen the business has been very largely protected by government support. So that's, I think, has interested a lot of people coming into the market. where you've had investors seeing that the fact that that has been insulated from those risk areas. Combine that with the sort of the shortfall demands, and therefore people are seeing it's a very good return because there is those consistent demands for beds regardless of the asset being old, because they're not building any. People are still needing care homes, and so if you can provide good quality care in a nice converted home that's been well invested in, it will run for a very long time. You haven't got a risk that it's going to probably lose out in 10 years time, etc. And then we're also just seeing a number of brokers, I think, off the back of all of this, where they've had long-established relationships, or finance advisors where they've had long-established relationships with people that own care homes, and they're a trusted individual, and so they come to them asking them to look at care home financing and seeking guidance on it, and therefore they're coming to us requesting that sort of understanding of the market and the sector, because they realize actually there are more and more people looking to get into it that perhaps weren't in that sector before but are interested in it now.
Okay, and as I said just after you finished, brokers becoming interested really because there is such a massive opportunity here.
Yeah,
and let's face it, with the aging population we've got, which is care homes going to be ever more popular in the future, and it is so massively underserved, as I keep saying, by lenders out there. So the timing of your product was absolutely fantastic. Really, really is. So, okay, we don't have any questions from delegates, which means you've covered everything in your presentation, which is great. So thank you very much indeed for your first time. We look forward to welcoming you again in the very near future, and maybe we're going to be meeting face to face very soon as well, hopefully, because Allica is quite a big part of what we do on our commercial side now. So hopefully we can get together and start actually meeting people physically rather than virtually, which would be nice.
Post-COVID world.
Speaking to people even in their bedrooms or their office at home. So thank you very much, Anthony. My IT team will remove you from the thing. Don't switch it off yourself, because we did have a delegate once who actually switched off the whole thing. Long-term friend of the Specialist Mortgage Web Show, somebody I've known since the 1990s, one of the industry's good guys. He will appear any second, hopefully. I know he's working from home today because there's a tube strike and he couldn't.
Exactly.
Yeah, Jim, your camera's a bit high. We can see your ceiling and an elephant. That's it.
Sorry about that.
That's all right. Don't worry. Not a problem. Okay, so a little bit of introduction first of all. As you can see, he's a human being and not a cartoon character. This is Jim Nash from Tuscan Capital. Huge amount of experience. There's not many people in the lending lending that have got as much experience as Jim. Across all levels, whether it's within customer service. He headed up customer services team for iGroup many years ago. Those of you who have been in the market a long time will probably remember iGroup, or Jim was one of these senior people there. I'll let the next bit. But first of all, this is what you've received from us this morning. So this is Tuscan's fairly brief, actually, idea of criteria. They're not staff-wise, they're not a huge lender, but certainly experience-wise, there's not many out there that have got more experience than the guys at Tuscan. MD of Tuscan is a personal friend of mine. He's been a mate of mine for years, as an example, or CEO, as he likes to call himself, not MD. I've been mates with Jim, I would say, for God knows how long. I don't know, no idea how long. But and they've also got staff that used to work for me. So we're in a great situation with Tuscan, and we do like to place business with them because they do get stuff through. They do get stuff away. So a little bit about Jim, industry veteran of many years standing. He's an experienced firsthand all the ups and downs of recent and not so recent financial services history. The majority of Jim's experience has been gained in broker-facing sales roles, including time spent with National Mortgage Bank, non-conforming lenders iGroup and Money Partners, and bridging provider Omni Capital. And he also done a bit of broking in his time too. A dedicated follower of the bridging industry, Spurs. Gold and Guinness, not Middlesbrough, obviously, but not necessarily in that order of priority. Jim does like a pint of Guinness. We don't normally try and contact him on a Friday afternoon, for example. Let's put it that way. Interesting fact, Jim was once on TV in a choir and sang with an old group called the Beverly Sisters, who are about the same age as Jim, by the way. The programme was Stars on Sunday. For those of you who might remember Stars on Sunday, I never used to watch it. He's only allowed to join the choir if he would promise not to sing, and he's promised not to sing his presentation today. So there you go. Jim, it's over to you. You've got about 8 slides, I believe. So over to you. I'll see you shortly.
Okay. Thanks, Tony. Right, so let me see. There we do. Have you got my slides up there, Tony, or not? Oh, here we go. He says. Okay. Hopefully, I'm not the best technician in the world, but let's see if we can get this one sorted. Right. Good morning, everybody. To those who've been here before, thanks very much. And to you new guys. We can go straight into this. Bridging lender. Between us now, I worked out yesterday that there's 150 years experience between just 4 of us in the company. So we've been around for a little while, as Tony's just explained. There's many of us out there, many bridging lenders. So my idea today is to say, why should you deal with Tuscan? Okay. Nationwide coverage, nationwide at the moment is just England and Wales. However, we are considering Scotland, but it's a slow process, and I'm not sure whether we'll get into Scotland within the next 6 months, most probably, but we are looking at that. Rates, we look at rates starting from 0.69%, but I'm going to say this many times, lots of things that I put on the slideshow are up for discussion and up for negotiation. So although I say rates start from 0.69, there are occasions when we can look to go below that, loan to values, in mitigating circumstances, all up for discussion. Term from 3 to 24 months. Now, we work to the open market value, unlike some operators who look to the 180-day or the 90-day value. We'll actually work to the 75% of the open market value on purchases, which obviously gives people a little bit more on their net figure. We'll do first charges, second charges. We do need consent for a second charge, but there are instances where we will consider taking an equitable charge if it's in support of an application. For example, if somebody said, look, I want to secure on this, my exit is on that, and we'll say, okay, we'll increase the LTV on A if you allow an equitable charge on the exit, because therefore that exit is more certain. And we're quite happy to do that, and we wouldn't need to go for consent in those scenarios. Loan sizes, 150,000 to 10 million. Again, exceptions will go below 150,000. We've got many repeat customers now, mainly up north, it is fair to say, and we'll do the repeat business, and we will come below the 150 up to 10 million. Again, we will go above 10 million if we've got the right sponsor standing behind the deal. We have one at the moment for, I won't say the name, but it's a recognised high street retailer who's looking to buy a substantial warehouse facility, housing facility, which is for in excess of 10 million. And we're quite happy to entertain that because of the sponsor standing behind it. Types of property. Okay. All types of residential properties are considered. So you've got your new build, HMO, semi-commercial, as you can see there, portfolios. We recently completed a purchase of 120 property portfolio. Somebody was buying it off of a brewery. Quite happy to stand behind something like that. We'll also consider all types of asset classes if they have planning permission in place to convert to a residential of whatever type it might be, a residential asset. So we're quite happy to look at that. Look at foreign national expats. We know your customer, obviously, anti-money laundering. We go through all of that. We have a worldwide facility for checking on applicants, because there are occasions where somebody might be considered even a PEP. But if they're a low-ranking PEP, we'll still consider that type of scenario. Loans available to individual, corporate entities, SPVs, offshores, all types of lending entities we will consider lending to, not a problem. Credit approved term sheet, it says there, typically issued inside 24 hours. That's now is a lot shorter. We're a small team. Almost said a short team, one or two of us are, but we're only a small team, and between the CEO, the finance director, work very closely, and to get a credit approved back terms would typically be a lot less than 24 hours now. Let's see if I can work my way down. Okay. All right. Facility which we have, which is very, very popular with us at the moment, is a refurbishment facility. It's where we will allow people to purchase, refurbish, and then I'll come on to another product which we just introduced in a minute, which will help them then exit that type of facility. So it's the first charge. It's the first charge, as I say, on properties which will have in place the permitted development planning permissions to convert to a HMO, for example, an enhanced buy-to-let. And what we'll allow is, at the time of lending, we're looking at 70%, typically at the time of lending. We'll do 100% of the build costs, and then we would base that on the loan to the GDV at 65%. And very rarely will it go beyond 65% for somebody who's doing this type of development, because in reality, it's maybe not worth doing the development if it's going to exceed 65%. We don't do ground up developments, and we do employ a project manager to watch the project as it goes along and to approve the drawdowns. Now, coming back to the actual 100% of build costs, we will do this, and what we think pretty good at is that if, for example, the purchase of the property is, for example, £100,000, keeping it simple, we would look at funding up to £100,000 of the build costs, and maybe even a little bit more, and still consider it a heavy refurbishment rather than a development facility. And on that basis, we do win some business, because some of our peers might only go to 50% of the original purchase price or valuation, some 75%, but we're quite happy to exceed those figures if it's a good proposal. The last point I've got on here is about the borrower to cover any cost overrun. What does happen, and has happened on a number of occasions with us, is where the surveyor has looked at the project and said, I don't think you can do it for that price. And to be honest with you, in today's market, of course, with the cost of materials, etc., that could most probably be true for many people. However, we have some who are tried professionals, and because of the way that they work and because of the contractor that they work with, they do get favourable rates. So where we have a difference between the surveyor and the actual client, we will still do the deal, and we'll say, okay, but if there's any cost overruns, you need to cover those costs. And we would ask them to provide evidence as to how they could cover those costs, but we're still quite happy to do the deal on that basis. Okay. All right. So now, commercial bridging. Commercial is something which I think ourselves and a number of our peers moved out of the market there for a little while because of COVID, but we're now back into that market. So we'll now look at 65% loan to value is where we're quite happy to lend at. Loans from 100 to 5 million. Although, as I said previously, there are some larger loans that we will consider substantially more than 5 million if the sponsor is of a secure tenant, good sponsor, and I think we all know what that would look like. Terms 3 to 18 months. So we'll do, again, nationwide is Wales and England. Purchases, refinancing, capital raising. Recently just done one where literally here was the asset. I needed to raise X amount. We looked at 65% loan to value, not a problem. Capital raising, taking out an existing lender, allowing them to capital raise and move on to another project. We have no issue with that at all. Type of assets, again, units, retail, office, warehousing, industrial premises. The issue there, land replanning that I've put into there. This is where, just to explain it a small bit, if you have a building which is sitting on a plot, but next to that, and that's a commercial unit, and next to that there's some land, which you say, well, look, we've got land next to it which has got planning on it, we will actually allow that land up to 55% loan to value on that land, in addition to what we're lending on that commercial unit. So we'll take land with planning into consideration, but it is only in addition to the unit that's already there. Assets are non-standard construction. 55% loan to value. It's down to you as the introducing broker to show us this is how we will be able to refinance it. This is what the exit will be. Quite often that could be sale, and quite often if you've got a cash buyer, they will buy a non-standard construction property. So as long as it's viable. Okay, this is just a quick summary, to be honest with you, of the types of deals that we've done. It's really just to show that we are nationwide. You know, Leeds, Southend, many properties that we've lent on. So you got the purchases on the right-hand side, purchase refurbishment. Some of them have been purchases where they've then bought as is, and then they've moved on to get enhanced planning to move on. Quite happy with doing that. The ones on the left, development exit bridges, we're more than happy to look at development exit. And in many cases, we will go higher than the normal expected on exits. Like, for example, because these are just examples of all the deals we've done. I won't link on those. You can ask questions in a moment. Just as examples here, we've got where we've gone to 72.5% loan to value on a development exit. And the reason why is because, like many of our deals, they're on a individual basis, assessed on an individual basis. Now, normally we'd say 70% on development exit, but here we had a large development in Pinner, which I knew really well, used to work in a pub there, and there's another development in Hemel. One of the units in the development in Pinner had sold. Another one of those in Hemel had also sold. So we had good comparables already in place. And because of that, we were quite happy to go to 72.5% as it worked out on the development exit. It was the monies actually were required because the client needed to raise monies as a deposit for another development that they were getting involved with. We were involved so intensely with this. We worked hand in hand to resolve a 106 scenario that they had to comply with. We had 9 conditions subsequent on the actual deal. So once it had completed, there were still 9 further conditions which they needed to comply with. But we could see that they had good team. They were professional guys, had it all in place. So we're quite happy to move on, as I say, refinance and capital raise. That, folks, is a very quick introduction to Tuscan Capital. As I said, feel happy to call us at any time. On the bottom here, you can see a quote, which was always accessible 24/7, which Tony Julie tested me on at about 9 o'clock the following night to see whether it was true or not. And it was. Okay. Any questions?
None from the delegates. Delegates are very quiet today.
It is very quiet.
Quite surprising. Tumbleweeds are like going across my office at the moment. So,
yeah.
Jim, got a couple of questions that you've set yourself. I think you've already answered one, but I'll answer. Maybe just expand on this. Will you lend to offshore companies and foreign nationals? Is the first one. I know you did touch on this, but maybe just a little bit more meat on the bones, I suppose. We don't see a lot these days of like offshore companies based in Liberia and that sort of stuff that we might have seen 10 years ago. That seems to have like all gone away. Or people trying to extract themselves against that and that.
Absolutely, and you're quite right. I think we'll see a lot less of it maybe. But there was one of the cases here where on one of the development exit deals, we worked with an Antiguan national who was a 40% shareholder in the company. He wasn't in the country, but we had to deal with him. And again, just talking about how do we deal with people who maybe are based abroad. Are we happy to have FaceTime discussions with solicitors who have got a branch out in whichever country it is, and they may not be back into the country here? We have quite happily dealt with the FaceTime solicitor here to the person sitting in the office abroad. We've done that on a number of occasions. That's been necessitated by not necessarily, we can't say COVID in this instance, but it has been necessitated by somebody who was stuck abroad once because of the travelling restrictions. So we were able to do a face-to-face scenario. Yes, we will deal with your SPV, as I say, your offshores. We look for them to have a footprint of some sort in the country, but which is they'll have some sort of a bank account or something here. So yeah, more than happy with any scenarios. You obviously go for a legal opinion on certain companies. Again, it's not a problem. We will consider all types of applicants. Just a high level PEP is the only ones we most probably wouldn't consider. Okay.
And of course, we'll always do our due diligence in any case that comes through. We did have a case last year where the guy was based in Dubai, and we said, "Where's the deposit coming from?" And he said, "Oh, it's coming from my brother." And his brother then declared the money had actually come from Syria and Iraq, and was significant. You're talking millions. So I Googled it and then found out that the US had lost billions of dollars in cash that had gone missing several years ago, which is probably where this guy got the money from. So we politely declined that particular deal. So, okay, we've actually got questions. Stevens asked a question. Will you lend against a planning uplift value on a standard bridge?
If you're talking about looking at lending against if they've bought it and then you've got an uplift, okay, if they're looking to take all of their profit out of that uplift and there's no skin left in the game, we'd have to consider that carefully. We'd have to look at what's the actual money going towards, and if we could follow the money. Does that make sense?
Yeah, potentially on a case-by-case basis. Depends on what's behind it and what else is available. So yeah, you're right. So if they buy it, get planning, and then want to take their money out, so there's like you say, no skin in the game, no pain for the client. I always like to call it. If things go wrong, then that potentially is an issue. It's an issue for most lenders actually. So
yeah, absolutely. But you can follow the money. That's absolutely fine. That's great.
Yep. Okay. You also set yourself a question: which asset classes will you lend on?
Okay, and that, to be honest with you, I think cover that. With asset classes, I mean, we've got one at the moment, I kid you not, on a police station, but that has planning in place for conversion to 9 flats. We've got one in place on a Buddhist centre, but again, there's planning in case. So any asset class that's actually got planning in place, PD, then we're quite happy to lend on it. But I don't want to mislead anybody. The planning or PD needs to be in place before we actually advance the loan.
No, absolutely agree. Jim, we've no more questions. No one's asked anything really. So just to sort of like, because we're way ahead of schedule, 15 minutes at the minute, which is great for me because I need to go to the toilet. But just really, as far as just to restate what I said right at the start. There's loads of bridging lenders out there, absolute stacks. I did a podcast with one of Jim's competitors a couple of weeks ago, which went live on LinkedIn yesterday. So if you want to have a watch of that, have a look. The due diligence that we now do on lenders before we accept onto panel is fairly substantial because we have to make sure, A, they're going to be around to actually lend the money. They're not relying on their money from just, for example, one high net worth investor who could pull the plug at any time. I know with Tuscan, for example, their sources of funding come from 4 or 5 different organizations or individuals. And we also look at what will happen if things go wrong. So if things do go wrong, such as we had COVID, which nobody would have said would have happened, say, 3 years ago. Well, it happened. And some of the practices we saw from some lenders out there were borderline criminal. They really were just people... 2 clients being asked to sign non-disclosure agreements when they've been charged over 100 grand in fines because they've gone over term in COVID and had no way of either selling the property or refinancing the property. Over 100 grand, sign a non-disclosure agreement, we're not 10 grand off the bill. That sort of thing should be illegal. And but unfortunately, what will happen is eventually the FCA will get wind of this and go, oh, let's regulate this particular area as well because we can get a few more quid in, pay more in bonuses to our staff possibly, or just employ another 1,000 staff maybe, who knows. But it is vitally important that you know who you're dealing with on the bridging side, because if it does go wrong, it's only going to come back on one person, that will be yourselves. So just ensure that you know that company is going to be around and what they would do when things do go a little bit pear-shaped.
I could give you a real live example there, Tony.
Go on in. You want to give me a live example?
Just very quickly, we lent on an establishment up north. It was a very popular hen-do location up north, and obviously with COVID, the entertainment place, all the business just fell away. You obviously couldn't have people in there, and we sat with that client now for the best part of however many months it is now. The client made efforts to make payments. They slowly, the business has come back, and slowly they could fill up the theatre that little bit by bit. And during that time, the client managed to, by their means, make half payments towards what their payment should be. We have stuck with them. Okay, this could be an exception. On this occasion, we haven't defaulted them at all. Okay, and they've actually opened up. They're back, touch wood, to full capacity. The tickets are selling like mad. They've got a show that's gone on the road, and we've stuck with those guys all this time, and they're coming good. And yes, they will make up what they owe us, but we've held it at our rate because we just understood the scenario.
And we've seen it with Tuscan as well, Jim, as you well know. We've got one client on the South Coast who's an HMO operator. We've been with him right from the start when he first started letting out property, and he's now driving around in a brand new Bentley. That's how well he's done. But he bought a property literally February 2020, applied for planning. Planning was stalled, so to convert into an HMO, the planning was stalled. Then obviously things started to come back a little bit, but then he found out there was a Facebook action group had been set up to block the planning. And he went over term. Now, Tuscan didn't call that in. They understood the issue. They knew that he was, they knew what type of operator he was. And we eventually managed to got the planning through eventually. And we then managed to do what we need to do once the works were done. And Tuscan stood with him. If we placed him with that other company that I just mentioned before, he'd probably be out of business now. Because the way that and I've got two clients who are now taking this as far as they possibly can because of what this company did. So again, just be very, very careful, delegates, just who you deal with on the bridging side, because there are some absolute cowboys out there still, unfortunately. Tuscan did not fit into that category. We've got packager status with Tuscan, so we can pay you what you would get if you went direct. Obviously, any of you out there, I would challenge you to have a better relationship with Tuscan staff than I have. Jim, Colin, John, for when I say donkey's years, I do mean donkey's years, and they're people that I can sit in a pub and have a drink with for quite some time. If I was drinking Jim, by the way, just 2 weeks ago, just so you're aware. But that's a relationship we have, and that pays dividends when it comes to actually doing business with somebody. So, Jim, it's just gone 6 minutes past 11. You are 9 minutes ahead of schedule, so thank you very much. Welcome back, everybody. We've lost a couple of attendees. Hopefully they'll be coming back fairly soon. We'll move on to the next one. I'm just going to make sure our next speaker is in the room. She is in the room. There she is. But she's there in front of me. Hi, Marie. How are you?
I'm very well, Tony. How are you?
Yeah, very well. Thank you. I'll crack straight on.
Yeah.
So we next have a managing director, no less, of West One. The West One. What is your official title now? Managing director of
Second Charges.
The Second Charges. There you go. So one of the most senior members of West One, who are one of the fastest growing probably lenders in our marketplace at this moment in time. And you'll receive 3 items for West One in the email I sent you this morning. This is just an example of one of them. I didn't want to put all 3 up, but just check your email and you'll have the details. A little bit on Marie, first of all. She joined West One in 2017, is currently the man director of the Second Charge division, overseeing loan origination, sales management, distribution, and product development. Marie has worked within the mortgage market for 25 years, starting out as a graduate trainee for the Yorkshire Building Society. Prior to joining West One, Marie was managing director of specialist distributor V Loans, one of our competitors, giving her a unique insight into the market from both the perspective of broking and lending. Marie has also held senior positions within the specialist lending market over the last 17 years and was appointed to the board of the Society of Mortgage Professionals in 2019, and I voted for her. She's one, again, very much same as Jim before. I've known Marie a long time, more years than I care to remember, and she really does know her stuff. Quite simply, she's been a broker, she's been a lender for numerous organisations, and she does know what she's talking about. Very simply. Marie's interesting fact, there is more stuff on Marie that I could have put up, but I didn't want to embarrass her. Marie once appeared in a Bryan Adams video. Explain, please, Marie.
Well, I went to one of his concerts in Sheffield. I think I was probably described as a stalker at that point as well, and they were filming a video. So I think it was when it was the VHS days. So I think I paused it and freeze framed it. So you literally see me put my hands up and down of about a second's worth of video probably. So yeah, but technically I'm in the video, right?
Absolutely. Is the restraining order still in place? Or
yes, absolutely. Yeah,
absolutely fine. We've just had a question actually, Marie. Michael said, "Hi Tony. You said you never vote. That you voted for Marie. You said that you voted for Marie. Previously, you said that you never complete any nominations. That's for awards, Michael. This was actually to be on the board of an industry trade body. So, and I thought Marie was the best person for the job. So there you go."
Thank you.
Right, Marie, it's over to you. Thank you for the question, Michael, by the way. I hope you're well. But Marie, it's over to you. I will see you 20 minutes-ish. I'll come back in 20 minutes and 1 second if you're running over time, okay?
Okay, thanks. So good morning, everybody. Thanks to Tony and the team for giving us the opportunity to speak to you today about West One and second charges. So just to give you a little bit of background about West One, we are the second biggest non-bank lender in the UK, rapidly going into all areas of specialist lending. So we currently provide, alongside second charge mortgages, we're the UK's leading bridging finance lender. We also offer development finance, and our most recent product launch was into buy-to-let mortgages, and that division is growing very rapidly. So we really want to establish ourselves as a go-to specialist lender. Now, all of our products can be accessed by specialist financial services. These guys are obviously experts in what they do, and they're very, very well versed in our products and our proposition and how we work as a lender. So every single product through West One is accessible through Tony and the team. What I like to talk about in terms of second charges, because particularly from an intermediary perspective, is really sort of link the opportunities for second charges in the current mortgage market that we operate in. And I think the first thing to say is that second charges, I've worked in this industry since 2003. And what I can really see now is some real momentum building in the second charge market. We saw it sort of in the second half of 2021, particularly on the back of the fact that during the pandemic, second charges really were impacted quite heavily, and the market contracted significantly during 2020. But we really did see a rapid recovery in 2021, actually outstripped our expectations in terms of market growth. And as a lender, we saw a record H2 in 2021. We had a record month of lending in both October, and we're starting to see some real momentum building in 2022. We've just come off the back of a record month for inquiries after trading for 5 years in the second charge lending market. So I think that really demonstrates that there is real value to second charges. And if I could give you one thing to take away, it's maybe thinking about second charges differently than you ever have done before. Lots of intermediaries tend to think of this as a product of last resort. It's a product only really applicable to borrowers with credit issues, and it really isn't the case at all. And the rates in the second charge market are the lowest they've ever been. We've got rates starting from 3.9% as an example, and we're really starting to see a different type of borrower coming to us, and I'll hopefully explain that as we go through the presentation. But I think the mortgage market is heavily intermediated. It probably accounts for about 80% of all mortgage transactions. And I think now more than ever, borrowers really do need the intervention of professional mortgage advisors. Circumstances have become more complex. coming out of the pandemic. You know, there are borrowers whose credit profile may have been affected detrimentally by the pandemic and may have been eligible for high street lending prior to 2020, but now find themselves really in a situation where if they were to remortgage, for example, they may have to go into a higher rate of interest. We're also seeing, as you know, a rising interest rate environment. So we've started to see swap rates increase, which impacts on the cost of fixed rates and mortgages. I'm sure you've seen that in the first charge world in terms of the high street lenders and others putting up the rates over the last few weeks. And we're also, a lot of homeowners are starting to see the energy bills starting to land. I know I was with somebody earlier this week who said they'd received their energy cost bill and it had gone up by 100%. So for families everywhere, disposable income is going to be squeezed, particularly over the coming months. And that's something, again, that's going to impact on borrowers' requirement and needs, and their circumstances are obviously changing and evolving all the time. We've also seen a little bit more restriction in terms of criteria for self-employed borrowers, and also around lenders' appetite around debt consolidation. And that's something in the second charge market that there is quite a lot of flexibility in terms of how we view self-employed borrowers, particularly because we look at every case on an individual basis. So we don't credit score our applications. We assess each application individually and try to really get an understanding of those borrowers' circumstances. So we can sometimes get a little bit more comfortable in comparison to lenders that use sort of a more of a computer-based decisioning approach, which is something that doesn't lend itself well to every single sort of borrower group and profile. In terms of why second charges are so relevant to you as advisors, there are maybe some areas of second charges that you've not considered before. So back in 2020, we actually launched some criteria specifically to support the bank of mum and dad transactions. That's something that's obviously ever growing as first-time buyers are trying to get onto the property ladder. And we see, you know, pretty good demand now for borrowers that are looking to release equity to support their children or their grandchildren, to help them get that first step into the property market. So again, you might not have thought about a second charge as a route to doing that before, but that's certainly an option through us and other lenders in the market. We're also seeing an increasing trend for borrowers looking to buy second homes, either as investment properties or holiday homes, by using a second charge to raise the finance for that. And the reason second charges lends itself really well to that type of borrowing is that sometimes that supports larger loan requirements. So we offer loans up to £500,000, for example, as standard on a couple of our product ranges. And we're starting to see some real larger loan requirements for borrowers, particularly those with higher valued properties. We've just launched an interest-only product, actually, which is targeted at high net worth borrowers who want to borrow a minimum loan of £100,000, and it's specifically for this type of loan purpose. So that's something, again, that we're seeing real traction for. Home improvements has always been a popular reason for second charges, but you know, that obviously became heightened during the pandemic. But now obviously we're seeing issues in the housing supply in the UK as well. So there'll be a number of borrowers who can't find the property that they're looking for, or actually a little bit nervous about putting the property on the market in case it sells very quickly and they can't secure the next step home that they're looking for. So we are expecting to see the demand for home improvements continuing, and just sort of linking back to the interest-only product that we've launched, that also is used specifically for high-end home improvement projects. So we see properties worth over £1 million where they might want to spend, you know, 150,000 or more on home improvements. That again is something that our second charge products lend themselves really well to. We're one of the few lenders also that offers buy-to-let second charges. So that's quite an underserved area of the market. Clearly, you have a lot of landlords that are on 5-year fixed rates because of the PRA changes that came in a few years ago. So it's a really useful way for landlords to access equity in their buy-to-let properties. And we've got a case study for you on that later on in the presentation, just to demonstrate how that works in practice. But again, a very popular product available through ourselves and another 2 or 3 other lenders in the market. We're also starting to see a real change in the structure of the mortgage market, in particular in respect of the take-up of longer term fixed rates. So 2-year fixed rates have always been sort of the mainstay of the first charge market, but we're now starting to see 5-year fixed rates become as popular, if not more popular, than 2-year fixed rates. And that means that borrowers are going to be in early repayment charges periods for longer. And during that 5-year period, if they do need to access further borrowing, again, a second charge might be the most appropriate way for them to do that. So something we are starting to see creep in. And I think that actually is one of the growth drivers in the market that we're seeing right now. And closely linked to that is the increasing popularity of the product transfer market. So we all know that product transfers now are becoming as popular, again, if not more popular than remortgages. The data for 2021 isn't available just yet, but we did see, even as going as far back as 2020, that actually in Q4, product transfer volumes were 4 times higher than remortgage transactions. And as intermediaries, you're probably acutely aware more than anybody that lenders' contact strategies are becoming more and more aggressive. They're trying to get to the customer before you do, offering fixed rate products well before the term expires. And also from an intermediary perspective, it's good to see now that you're being remunerated for completing product transfers as well. But if the borrower does go to the lender directly, often these are done on an execution only basis. And equally, even if they are intermediated, they're often done on a like-for-like borrowing basis. So that leaves a lot of borrowers with further borrowing needs that might not be addressed at the time of the product switch. And it gives you an ideal opportunity to revisit those clients, particularly if you're offering a much more holistic range of advice products, to go back to those borrowers and just see what their needs are. Are they changing? Is there a different type of product you can offer to meet those needs? And second charges fits really well into that, that contact strategy that it would be great to see intermediaries developing more and more. So one of the things we like to talk about, again, is really extending your scope of service to help retain your client bank, because not only are banks and building societies trying to get to your client first, you'll also see a range of online aggregators, moneysupermarket.com and the likes of those guys, who will then generate a lead, send that to a mortgage broker who may well offer second charges and other products, mortgage protection. And it really does put your client bank at risk if you're not offering the same range of products and moving towards a more holistic advice process. And it also gives you the potential of much better customer outcomes, because if you are narrowing your advice to more traditional remortgage products, again, that might not be the best solution for borrowers. And particularly, I mentioned earlier about borrowers whose credit profile may have deteriorated as a result of the pandemic, or other circumstances, maybe a one-off life event. So for those borrowers, product transfers make complete sense, because that way, obviously, they can retain the high street rate. That's where, again, the value of a second charge really comes in. And that's a really good example of where you could deliver a really good customer outcome through that. Second charges are really quite a simple product. They look and feel exactly like a mortgage product, because that's exactly what they are. It is a mortgage. It just happens to be a second charge mortgage. But Tony and the team at the Specialist Financial Services have worked in second charges even much longer than I have even. They really know the market inside out. And in terms of evidence and research, if you need assistance with that, these are the guys to speak to, because it's not just about what's the rate of interest, it's knowing which lender could support the client best based on their circumstances. So that's where Tony and the team really can add value to your business. You don't have to give advice. That, again, can be outsourced to Specialist Financial Services. Or if you do choose to give the advice, that's also absolutely fine. But again, you can use Tony and the team to process the case for you, because we only distribute our products exclusively through specialist second charge brokers. So they really know how to get a deal across the line as quickly as possible for you. If you are an independent broker and describe your services as independent, you must consider second charges alongside remortgage products. So again, that's something that if you are having to offer advice for second charges, you can still get support from the team at Specialist Financial Services. So there's lots of different options and ways that you can access second charge products. The opportunities for second charges really come in terms of how you can access additional borrowing without disturbing first charge mortgage terms. So we've talked about borrowers who are in ERCs and longer term fixed rates. We've talked about borrowers who have had a change of circumstances since taking out additional borrowing. And also interest-only borrowers are an interesting one. I've got a case study for you on that in a couple of slides, but that's again where you'll probably know lenders where you've got borrowers who have an existing interest-only mortgage. They want to borrow an extra £20,000, maybe for home improvements or some other loan purpose. And the lender conditions the borrowing on them converting their entire mortgage onto a capital and repayment. So that extra 20,000 becomes a very expensive transaction. Also, second charges offer quite a lot of flexibility in terms of terms. So you can take a term that varies. It doesn't have to be the same remaining term as the existing mortgage. It can be taken over a shorter term, or it can be taken over a longer term than the existing first charge. So it just gives borrowers flexibility in terms of their budget and what their needs and preferences are. Loan purpose as well is pretty flexible. Pretty much any legal purpose is considered for as a second charge. So like I said, as well as the sort of more traditional loan purposes such as home improvements and debt consolidations, property purchases, school fees, tax bills, business purposes, these are all things that can be accommodated through a second charge. In terms of speed of completion, one of the benefits of second charges is that there isn't really any post-offer conveyancing. So I know one of the frustrations in the mortgage market is you can get reasonably good service to get a deal to offer, and then it can take several weeks to get the loan completed because the conveyancing is being taken care of by a panel solicitor. So levels are really poor. So it can take weeks for funds to be released to the borrower, particularly if they're capital raising. With a second charge, typically, once the offer is issued, the offer can be returned and completed the same day. So unless the borrower needs something like independent legal advice, which again is not very intrusive service that's required, then actually the speed of completion of second charges can really outstrip remortgages, particularly if there's a deadline that the borrowers are working to. There's niche lending as well, so inclusion of non-owning spouses' income. So if you've got a couple that are recently married and the property was in one name and they want to add the other person onto the loan for affordability purposes, or just obviously as from a commitment perspective, then usually for a second charge you can do that. Conversely, if the borrower is married and the property's always been owned in their name, we can look to offer the loan in one name only and not have to add the spouse onto the loan just because they're married, or cohabiting as well. So that again is something that's a little bit of a niche, but is very popular actually within the second charge world. And it's also an alternative solution for borrowers looking to consolidate debt. So we're highly experienced in debt consolidation. We pay all the debts off directly through BACS transfer, so there's no danger of the borrower not repaying those debts and repeating the same issues. So again, debt consolidation is something we can really help with. So we talked about interest only and being a driver for second charges. So in this example, you've got an interest only borrower looking to raise an additional 50,000. They've got a mortgage of 300,000 currently on a 5-year fixed rate 1.75 and the monthly payment of £437.50. To take the further advance with this particular lender, it's conditional that all of the borrowing is converted onto a repayment basis. So it would actually take the combined payment to £1,411 per month based on a 20-year term. So in effect, an additional 50,000 worth of borrowing is going to cost them an extra £1,000 a month. By leaving the by leaving the first charge arrangements in place, so leaving the interest-only mortgage as it is, keeping the payment of £437.50, a borrower could take a second charge, for example, at a rate of 4.25 on a repayment basis, taken over the remaining term of 20 years with a monthly payment of £309.62. So that would take the total payment to £747.12, saving the borrower £663.88 per month. So that's a really good example of where a second charge clearly is a much more cost-effective solution than remortgaging or taking a further advance out with that existing lender. So just in terms of our second charge range, as I mentioned earlier, we've got variable and fixed rate options starting from 3.9%. We have a 5-year fixed rate that only has a 2-year ERC period, so it offers flexible ERCs on a couple of our 5-year fixed rate products. We can lend up to 85%, both for employed and self-employed and retired applicants. We'll allow loans to go to the age of 85. So the loan has to be finished by their 85th birthday, but again, assists slightly older borrowers looking to raise finance. We can take up to 100% of regular overtime commission and bonuses. So that gives you extra flexibility in terms of the affordability. And our affordability is based on automated expenditure. So we carry out an ONS assessment in the background. We capture 3 expenditure items in things like childcare, council tax and ground rent. And the affordability assessment then is completed. So at the point of sale, Tony and his team will know whether that loan is affordable for the borrower that you're referring through to them. We also have some products that don't have loan to income restrictions. And on our Apex Zero range, which offers our lowest rate of products, we can go up to 6 times LTI on those products. So again, a little bit more flexibility than you get in the first charge market. We also offer loan terms up to 30 years. So again, just gives a little bit of flexibility in terms of affordability by keeping the payments lower where that's appropriate. And as I mentioned earlier, all of our loans are underwritten individually. It's a bespoke approach to underwriting. Every day we have a case referral meeting where we discuss cases which don't quite fit our criteria. And that's with our senior risk team and myself and the sales team that are involved in our cases. So again, just shows you the sort of lengths that we go to really try and help as many underserved borrowers as possible. Moving on to our buy-to-let range. So again, it really is an excellent opportunity for part-time and professional landlords to access equity. So there's a variety of loan purposes, but some of the most common ones that we see are refurbishing existing buy-to-let properties. So that helps to increase rental yield and value. Also to facilitate further property investments, either by raising a deposit or raising the funds for an outright purchase. But these loans can also be used for personal use, so debt consolidation, home improvements to the main residence. That's again, we had a deal this week where the borrower wanted to extend the lease on their residential property, and they raised the funds on their buy-to-let to do that. So again, that's a really good example of the flexibility of having second charges for buy-to-let properties, which might help with personal aspirations for borrowers as well. So this case study is about a professional landlord who has a number of buy-to-let properties in their portfolio, and they needed £150,000 for a property purchase. They had an existing first charge with the high street buy-to-let lender on preferential terms, so they didn't want to remortgage because they would have sacrificed their preferential rate. And because our borrowers had an extensive property portfolio, which were all self-financing, so they were all let out, the mortgage profile was all conducted well, they're experienced landlords, it was quite a straightforward application for us. We can also offer up to 3 loans per landlord. So if they've got 3 separate properties, we can raise funds on all of those properties if they wanted to access a higher loan amount, for example, by drawing equity from individual properties. That's something that we can assist with. But in this particular case, we arranged a £150,000 loan on an interest-only basis at a rate of 5.99, And the exit strategy in this case was a sale of the buy-to-let property. So that's quite a typical application for us that we see. And again, like I said, it's just really helpful for landlords to have those additional finance options. So we offer variable 2 and 5 year fixed rates up to 75% LTV. That also includes consumer buy-to-let properties. It also includes licensed HMOs. We can consider expats by referral. So it's quite a flexible product. It also offers options for properties that are rented out to DSS tenants. So quite a flexible product, really straightforward debt service cover calculation based on the lower of the rental income or the rental income assessment from the valuer. And we offer interest only on all our buy-to-let products up to 25 years as well. So quite a really good product, actually. So in summary, second charges really do add value to service propositions. So please, if you're not offering second charges at the moment, there's lots of reasons why you should be considering those, even from a best advice perspective. Even if it's just to say that you've considered the option of second charge, it's not going to be the best advice for everybody, but there are going to be an increasing number of borrowers where a second charge can really help meet their aspirations and borrowing needs and preferences. It can really help add value to your business because you're providing additional services that other brokers might not be offering. And again, really demonstrates that the quality of advice that you're providing is based on holistic advice and not on a narrow product selection. As you're probably aware, second charge mortgages are regulated in exactly the same way as mortgages. So there's full consumer protections afforded to any borrowers looking to take out a second charge mortgage. It's a complete level playing field. Your permissions are the same. So really it is quite a straightforward process in terms of offering second charges. And you don't have to be on the hook for the advice if you feel like you don't know the market well enough to advise. That's something you can outsource to Tony and the team. Just bear in mind, again, if you've got a tight deadline for a borrower looking to raise capital, speed of completion, we offer AVMs on quite a large selection of our products now. So again, sometimes a desktop valuation suffices. So that really speeds up the process too. But the main point is that there isn't a requirement for lengthy post-offer conveyancing, which can often delay the release of funds. And we do offer, we're a specialist lender. We want to help borrowers who may otherwise be financially excluded or underserved from the high street. So again, we want to understand the full circumstances so we can help as many borrowers as possible once we can establish that loan is affordable and it's a good customer outcome for them. As I mentioned earlier, our full suite of products is available through the Specialist Hub. So we're very proud to partner with those guys, and just really thank you for your time, and hopefully it's been useful for you today.
I didn't cut in at 20 minutes, Marie, because I was enjoying it so much. That, I wanted to hear more. So I've made a couple of notes myself, just stuff that I'll probably add to. Again, no questions from delegates. So I'll jump straight into the questions you set yourself. Which are you seeing any changing trends in the second charge market, and what do you think is the outlook for 2022 and beyond?
Yeah, so I think earlier I mentioned about a different type of borrower coming to us for a second charge. It's, I think there's a lot of stereotypes associated with second charges. We're starting to see some real sort of high net, what you consider to be high net worth borrowers. We did a loan earlier, or just late last year actually, for a guy employed by a very well-known bank on about 250,000 a year, looking to raise $500,000 for a second home property purchase. And that sort of scenario is becoming more and more popular. Our average loan size actually is around 60,000, which is about 15,000 above the industry average. And I think we do tend to see more borrowers who maybe potentially are in ERC periods, or it just doesn't make sense to remortgage because they've got such a great rate, coming to us and accessing, very low rates of interest starting at 3.9%. So that's an important point to mention. I think the outlook for 2022, from my point of view, this is going to be the biggest year for second charges, not only since the credit crunch in 2008, but since seconds were brought under the mortgage regime, where, all loans are fully advised. Obviously, all second charge advice, has to go through the same rigorous rules as a first charge product. So it's great to see that growth in a sustainable environment as well.
You've actually already answered your second question that you set yourself, which was how that intermediary can access. So that you've already said it's a very restricted panel. As a second charge market is really, it still is, always has been, because not only is it very niche, but I believe you still only have one BDM. I think Pauline's actually watching this at the moment. Hi, Pauline. And she can't get out to thousands upon thousands of people for obvious reasons. It's just, it's an impossibility. So we've been, I mean, I started, you said about me being in second charges. I actually started before calling off periods were introduced in 1985, and then went through all of that, and have now come out the other side 2016 when calling off periods were abolished, which was great. It's a completely different market to the way it was in the 80s, the 90s, things like Rule of 78 redemptions, all gone. It is now a mainstream product, whereas before it could be fairly restrictive, but was very, very popular in those days, but could be very, very restrictive for people looking to maybe just borrow something for a couple of years and then redeem it. It could cost them a fortune. It's a very different product now. So anything you've heard about second charges from the past that's adverse really isn't the case at all now. It's a completely different marketplace. I can't believe how much it's changed over the last 38 years, but it has, and it's moved forward.
Absolutely.
The good thing is it's cut a lot of the cowboys out as well, the cowboy brokers that were out there, and a couple of cowboy lenders as well. Which is well, actually I say a couple. There was plenty of cowboy lenders in second charges going back 30 years ago. They've all gone.
Yeah.
So, Marie, I haven't got anything else. I'll probably just add one other thing. You mentioned buy-to-let seconds. As I said in my initial bit right at the start of today, where you've got your clients that are in 5-year fixed rates and they need to do some work to the property to bring the EPC rating up to a C or above, this is probably the product that you should be looking at. So start contacting your clients, go all the way back to 2017, see what they've got. Because if they are in fixed rates, then they're not going to want to experience very high redemption penalties on their mortgages when they can take a second charge over a certain period and then look to repay that maybe further down the line when their 5-year, 7-year, 10-year fixed rate is up.
Yeah.
So great business opportunity. Marie, thank you very much indeed. I'm just keeping an eye on the time. Brilliant as always. And I will speak to you very soon. Simon will remove you from the meet, not remove you, but just take you off as a presenter. Just in case any problems. I know our next presenter is waiting, and I will just move this forward. Our next speaker, Patrick Doyle, known to us as Paddy. Again, not someone I've actually met face to face because he came on board during various lockdowns. There he is. Hi, Paddy. Can you hear us?
Hi, Tony. Can hear you nicely. Can you hear me?
Great. Okay, I will crack on. Everyone, you should have received. There will be 3 items for Lendco as well. Lendco is probably the best lender you may not have heard of. Let's put it that way, because they're not particularly well known in the marketplace, but they do write a hell of a lot of business. Fairly restricted panel once again. They don't go out to everybody. You probably won't see them on the sourcing systems, but they really are a great lender. They've been going now, I think it was around 2018, 2019, 2018, I believe, that they launched, and a great lender to have on board. Okay, so a little bit about Paddy first of all. He's been with Lendco. It said 6 months on your notes, Paddy, so I changed it to 2021 because the previous one said 6 months, and I know you presented last year, so I presume it's 2021. Previously a BDM at Leeds Building Society. His route into financial services has been a little different than most in the lending space. I do like this. Starting in commercial risk and recovery at Lloyds before a hiatus in vascular science, performing ultrasound scans for the NHS. It's a slightly different career change. Outside of the working world, Patrick is a keen sports person, athlete, and questionable dancer, aren't we all? That dancing is my speciality. Okay, and this is my favourite of any speaker we've ever had. Interesting fact. Patrick once played in an FA Cup game that reached national news due to 6 players and staff being sent off due to the colour of their underpants. Just give us a brief explanation.
It was very surreal. I think I was playing for Bath City at the time. I played against Newport in one of the sort of qualifying rounds of the FA Cup, and one of our players had some undershorts on that were a different colour to the black shorts that we wore as part of our kit. So wasn't within regulation, but the referee sort of made him change at the side of the pitch, which caused a bit of an uproar, and then proceeded to dismiss 3 or 4 players and 2 staff as well. So the game ended in chaos. I think we lost 6-0, unsurprisingly, but there we are.
You made a stand about your underpants. That's the main thing.
Indeed.
Paddy, I'll let you get started. I will see you in 20 minutes.
Thanks, Tony. Lovely. Thanks all for joining as well. Tony stole my tagline about Lendco being the best lender that nobody's ever heard of. It is what we try and sort of brand ourselves as we are relatively unknown. So we'll have a look and see what sort of sets us apart and what makes us useful as a lender. So we are intermediary only. As Tony touched on, we have got a limited distribution panel. So we've got about 160 firms registered to introduce business into us. Obviously, Specialist Hub are one of those. So packages are a real sort of cornerstone of our distribution strategy. It's probably why you've never heard of us, and similarly why we don't appear on sourcing systems. And the main reason why we are invitation only is so that we can provide a good service to a select number of brokers that operate within the specialist buy-to-let space that we operate in, so that we can ensure sort of positive broker and customer journey throughout. So I suppose the main points about what make Lendco different to a standard sort of specialist buy-to-let lender is that we truly do manually underwrite every single transaction. I see the credit risk papers that the underwriters put together when they're underwriting a case. It is sometimes quite laborious for them, but it does mean that we get to the right decision for every case, to the best of our ability anyway. And it does also allow us to look through and lend on cases where traditionally a computer would say no, but we can make exceptions to our own policy, and also look at sort of mitigants on reasons to do cases rather than to not do them. We also have online portal access, and all of our sort of application processes online, which makes it very easy for sort of uploading documents and for brokers to track cases as well. As part of the manual underwriting, our underwriters are always accessible as well, not only to me, which is a blessing, but also to brokers who will, they'll happily chat through cases to ensure correct understanding rather than saying, well, this is what I think, and it being a no. So that's also useful, and our current service standards, despite sort of turnaround, our current service standards, despite manually underwriting every transaction, is currently about 28 calendar days from application to offer, and that's despite receiving quite a large influx of applications since the turn of the calendar year. So we'll touch on a little bit about our criteria, where we are tending to be most useful for borrowers. We usually lend to experienced property professionals, albeit we can lend to first-time landlords as well, but not first-time buyer, first-time landlords. We always want to see that applicants have got a UK property footprint, and we'll touch on more on the UK property side of things in a moment. But most of our applicants, I would say, sort of upwards of 85%, are portfolio landlords, repeat customers that are coming back to us for further funding to expand their portfolios, following doing some purchase applications with us previously. That being said, we can do first-time landlords, and these are all up to 75% loan to value, which is useful. In terms of other sort of borrower profiles that we look at, foreign nationals and expats are acceptable. Foreign nationals, we tend to say actually anybody located in the European economic area. Southeast Asia, there's some select countries there, North America, including Canada, Israel and South Africa, Australia, New Zealand and India as well, being the ones that others are less keen on from experience, but all ones that we can consider. And that extends to applicants that are employed either based in those countries or actually anywhere in the world. So we've recently completed on a loan for a French national who was in Mozambique, of all places. They were a project manager for a well-known piri-piri chicken restaurant in the UK, but based out in Mozambique. They just wanted to do a remortgage on a property that they had previously lived in. And their circumstances made it quite difficult, but we sort of understood that their income of, I think it was about £30,000 sterling, went a lot further in Mozambique than it would have done in Southwest London, for example. So we managed to get comfortable with that. It was also about 35% loan to value from what I recall, just on a like-for-like basis. So we managed to get comfortable with that. Obviously, we had to look through the sort of source of wealth and evidence of the documents as well, which we managed to look through. But that was a good example of us sort of manually underwriting a case where traditionally would have been probably quite challenging to place. And we can also look at self-employed applicants. We tend to ask for £75,000 income for self-employed applicants. Also, expats can be based anywhere in the world as well. Loan sizes, we could do loan sizes up to 3 million. We are just in the process of increasing that to 4 million as well. That's 4 million up to 65% loan to value, 2 million up to 75% loan to value, and that's per asset, with a maximum exposure of about £10 million per borrower as well. We do have a cap at 65% loan to value for foreign nationals as part of that offering. Excellent. In terms of property types, HMOs, we can do up to 8 bedrooms, up to 75% loan to value. We very often ask HMO landlords if they've got 2 or more single unit buy-to-lets for at least a year before they go for a HMO at 75% loan to value, just to ensure that they've got the experience. And stress testing on those HMOs will be 150% for basic rate taxpayers or limited companies, or 170% for higher rate taxpayers. And that's all at pay rate on a 5-year fix, which is actually the only offering that we do at the moment is all 5-year fixes. Multi-unit freehold blocks. This is where we've seen a lot of growth actually over the course of the last 9 to 12 months. We've got some flexible criteria around multi-unit freehold blocks, and we'll touch on a little bit about how we try and structure some of these deals as well. So as it reads, we can do these up to 75% loan to value with no limit on the number of units within a block. So to give you a couple of examples, we've recently completed on a student block in Nottingham, which had 36 units within a block, value of 3.7 million. They were looking to borrow 1.7 million to exit some of the existing finance that was on the property after some renovation works were done to it. Some of these blocks were actually less than 30 square meters. Some of the units within the block were actually less than 30 square meters, which is not a problem for us. We sort of understand that, whilst the units on their own, if they're less than 30 square meters, tend to be difficult to mortgage. That's the reason why they keep them in the multi-unit freehold block. So with those, we sort of understand that actually they're only ever going to be sold to an investor. They're never going to be, carved up and sold to a residential occupier because of the difficulty in mortgaging them. So we tend to say that we can lend off the investment value, and this is another sort of key point around the valuations that we do, is that we often get specialist valuers to value properties. So instead of using a valuer who's probably a bit more suited to single unit properties, we've got specialist valuers like the likes of the VAS panel and the appraisers panel, who will value properties on a long form valuation, giving us investment value as well as aggregate value, which means that we're able to be a little bit more flexible and actually in some cases allow applicants to borrow more money at lesser rate because of the loan to value. I'll touch on another example of that shortly. And as a touch on for single units, we operate on interest coverage ratios in line with the PRA. So 125% for basic rate taxpayers and limited companies, 145% for higher rate taxpayers. And that's product pay rate, which is on a 5-year fix, 5.5 on a 2-year fix if we reintroduce those products as well. So moving on, there's a little bit more about our parameters of lending. We are a securitization lender, so it does mean that we have got some restrictions as to the parameters and the thresholds that we can lend to, which are outlined there. Most of the time, yeah, we most of our loans probably sit between the 70 and 75% range, with an average loan size historically of about 430,000. Actually, more recently, since we've moved up the risk curve and increased our loan sizes, historically we were up to 1.5 million, up to 75% loan to value, now up to 2 million, up to 75% loan to value. We actually did average loan size of 590,000 so far this year. We write interest-only loans only. We do have the overpayment facility as well, so applicants can make the standard 10% overpayments without incurring any ERCs, which is also useful for those that are looking to grow their equity. Yeah, and that's just a little bit about us. I'll talk to you a little bit about our background, so you've got an idea. So we are sort of working in the specialist buy-to-let area. As Tony quite rightly mentioned, we were formed in June 2018, born out of the brokerage that is SPF Private Clients. We had our first completion in September 2018 and have secured close to £900 million worth of completions since that date. So it's been a fairly rapid growth over the course of the last 3.5 years. We are still relatively small, so there is myself. I'm sure there's a slide on our contact details as well. There is just myself, 3 other BDMs, a team of 10 underwriters, 10 case managers as well, making up a total of around 35 staff in total. So we've, so yeah, it's been fairly busy last 12 months or so. We also do a touch of bridging, albeit sort of 80% of what we do is the specialist buy-to-let, and only really 20% of our offering is bridging finance. The most of the bridging that we do is the sort of refurb to let stuff that a lot of people do, or bridge to let as it is also termed. So very often we see applicants purchasing a property and they will take purchase for 300,000, for example, do some works to the property on the bridge, add £50,000 worth of works, bring up the value to 450, for example. So we'll do 75% on the purchase at 300,000. We'll then do a buy-to-let remortgage to take them out at 75% of the increased value of 450. We will send out a valuer just to ensure that the works have been done to a reasonable standard, and the valuer will have initially gone out and said, this is the property. These are the works that they're going to do to the property, and as a result, this is what I expect it to borrow. So it is just a re-inspection rather than a whole new valuation, which makes it a little bit easier, and also does give peace of mind to borrowers as well, that they're not going to get stuck in a bridge, which is also the reason why we underwrite the buy-to-let exit at the same time in these cases, so that we can ensure a swift transition to a buy-to-let, so they're not paying higher interest for any longer than they need to be, which is grand. Happy to open up to any questions.
Thank you, Paddy. Excellent. Nothing from delegates. Tumbleweed again, unfortunately, but luckily is a couple that you set yourself earlier. I did miss about 2 minutes of your presentation. My apologies. I just had to pop out. So, but so if you already answered these, forgive me. What's the maximum number of properties a landlord can have in their portfolio with Lendco?
Thanks, Tony. So we've actually got no maximum number of properties within a portfolio. Some have got upwards of 100. I'd say the average of what we see is probably around sort of 12 to 20 or so, and we will do sort of some of their portfolio. Alternatively, we've also done some recent portfolio refinance as well. One that does stick in mind was a portfolio of 14 properties in Tunbridge Wells that we've just refinanced on a day one remortgage. So this was one that actually we sort of not bent our own criteria, but we decided it was better to underwrite it a slightly different way. So they were the applicants were offered to purchase this portfolio of properties from a vendor at a bit of a discount. So I think the value was 3.7 for these 14 properties. They had been offered to purchase them at 3.3. Historically, we'd just lend off of the lower of the purchase price or the valuation. But in this instance, we said, actually, we'll just lend based off of 90% of the purchase price, just to ensure they've got some sort of skin in the game, if you like, whilst we, because we understood that they were sort of good borrowers as well. So we actually decided that we were going to write against 90% of purchase price, which did give us sort of coverage. I think it worked out about 72% loan to value. So yeah, slightly different method of underwriting, but they were experienced portfolio landlords with about 80 properties in their portfolio, just looking to acquire these as well. So yeah, no maximum within a portfolio.
Okay. And second question you set yourself, are you able to lend in consumer buy-to-let scenarios?
Indeed we are. Yes, our French national in Mozambique was technically a consumer buy-to-let. We also do a lot of let to buys. We had one recently where somebody was somebody letting out their own residential property to go and live on the farm that they were working at. Not my lifestyle choice by any stretch of the imagination, but it worked for them. So yeah, we got comfortable with that. We could see that the property was going to be let before completion. And also they had a forwarding address, which was relatively local. So no huge concerns with those either.
Okay, no more questions. I'm just going to add, just with regards to Lendco, I mean, I said, and I know you said, the best lender you've never heard of. They really have been invaluable, not just for cases that others just will not touch. It's the systems that are in place. We put an application on the system. The client is then sent the email with to sign with documentation immediately. It's just very, very slick, very, very professional, very, very quick. Also helps, I'm very good friends with Paddy's boss, which obviously when there's situations where we've got something that's slightly out of the ordinary, as long as I've got full details in the case, I can speak with him and say, what do you think? And that helps tremendously from time to time. It's all about relationships.
It's hugely useful, Tony. I think as part of that as well, often when we do have a case like that, or there is a case that is a little bit unusual, we have a credit forum call. So it's myself, it's Alex, who you're probably referring to, a number of other sort of BDMs and all of the credit team. We get together actually every morning at 10 o'clock, very regimentedly almost, to discuss cases that are bizarre over the course of the last that we've seen over the last 24 hours, or cases that we think that we should do but don't quite fit the mold for whatever reason. And we have a fairly open discussion to either get comfortable or decide very early on that it's not going to be one for us. And that really gives sort of surety of execution right the way from application to completion, because that's almost like our Lendco promise, if you like, if it goes through our credit forum. And we say that we'll do it as long as everything documentation-wise and valuation-wise stacks up, then we do ultimately get comfortable with it, which is a real asset to lending in the specialist space. I think you'd agree.
Absolutely. And just everyone, just one thing to remember, if you remember anything from Paddy's presentation, there's lots to remember. 30 square meters on multi-unit freehold blocks. Just remember that, less than 30 square meters. You all know how difficult they can be at times. Paddy, thank you very, very much indeed. Simon
Tony.
will exit you as a speaker. You can continue watching if you want, listen to me droning on for the next half hour or so. But
I'll treat myself.
thanks once again. Very much appreciate it. We'll see you face to face, hopefully very soon. So
Indeed.
this is the final part of today, which is my presentation. So some of you will have heard this before, obviously. I realise that. Hasn't changed too much. I try and add new bits to it every single time, but I can't rewrite it every single time because there's a lot to be covered. So, but this is just really a little bit of information about us and what we can do for you. Because again, some of you might never have heard of us. That's why we've been told actually we are the best broker and packager that you've never heard of, because we don't put ourselves up for awards. We're not in that space at all, and I'm going to cover that in a little while. But quite simply, what we do, we've been doing it a long time. My staff have been doing it a long time, and what we do very, very well. I always start off this presentation by just reiterating something from a third party. So this was the NACFB all the way back in July 17, compliance visit, face-to-face compliance visit. And he walked in probably expecting it to be a horror show, because he told me afterwards there was a few horror shows, as you can imagine, that he'd seen. And this was his comment. I won't read the whole thing. In reality, I do not see what you do as moving the goalpost, more a case of better than best practice, particularly considering the resource you have available. So very well done. Off the record, he said to me that quite simply, we were the best by a country mile when it came to compliance. If the NACFB were to do awards for best compliance from a broker, no doubt we'd be right up there, but they don't, unfortunately. But then in 2020, this was just before lockdown. This was then, and this, again, I won't read the whole thing. We identified no gaps in compliance. The regulation identified areas of best practice, notably in anti-money laundering and data protection controls. Something we're very hot on. But again, absolutely nothing to be concerned. We are not considered high risk in any way whatsoever. We were due to have our next NACFB compliance last month, but for reasons of COVID and other areas, it's then been delayed. So that will be, we're having it before the next one. So hopefully I can actually then let you have something more up to date the next time as to how we're getting on. But really, we've improved everything we do, so we know what it's going to be. So a little bit about us. Obviously, what we offer is a partnership. There's one term I hate within the packaging world, which is master broker. I think it's quite derogatory to call yourself a master broker, as if all the others really don't know what they're doing. Quite simply, what I see as a partnership is a partnership between you and I that is there to help your customers obtain the finance that they're looking for on the rates and repayments that they would like to see. And it's very much about two entities trusting each other. Now, always when somebody uses us for the first time, always very nervous. Are they going to get paid? I remember one guy all the way back in 2010, who's now my second biggest introducer ever, was absolutely panic stricken because he thought because he'd never heard of us before, gave us a deal, and he thought we were going to nick the case off him. He thought we weren't going to pay him. He's now earned from us over 750,000 in 12 years. So, and I'd now class him as a personal friend. He quite often invites me up to his parents' farm where he lives with myself and my wife, and we spent a few days there enjoying his hospitality. It's very much a partnership, though. It is very much about trusting each other. I have to trust that you tell us the truth when you're introducing the client to us, because that doesn't always happen, as you can probably imagine. And you have to obviously trust that we will pay you when we say we're going to pay you, that my staff can do what they say they can do. And it's all about getting that deal through in the quickest time possible, because that's what your borrower is interested in. The quickest time possible. There was always two things that clients used to ask me when I used to advertise in the national press: pick up the phone, how long will it take and how much will it cost me? That's all they were interested in. We want to help you grow your business. There's various ways we can do that by helping you stay the right side of legislation and compliance, because I mean, it says in the final bullet point there, our industry is terrible at keeping people up to date. You probably, if you directly authorise, you'll get the FCA updates, which really don't make a lot of sense half the time. I read them and think, what the hell? You might get AMI updates, but really there's very little that comes out. There's nothing that comes out of the ICO ever that I've ever seen that is particularly relevant. But we want to make sure that you are growing your business, because it's all about that long-term relationship. I want to be dealing with you in 10 years' time when I'm just, how old? I'd be 68 years old. God, that doesn't even bear thinking about. 68 years old, still dealing with you even then, hopefully. It doesn't matter what your FCA status is, DA, AR. If you are an AR and we're not on your panel, speak to the people, the powers that be within your network, and say to them, you should be adding Specialist Hub to your network. We are currently writing to all the networks. We do know most of the networks, but just to say we are now looking to join. If you want to give us a bit of a helping hand, please do so. If you're an exempt professional, accountant, solicitor, surveyor, whatever, absolutely no problem. Not authorised is a bit of a sticky problem at the moment because our PI cover will now not cover business introduced by non-authorised people. So, but there are solutions available. If I'm happy that somebody is above board and will do things the right way, then more than happy to have somebody join us as an introduced or appointed representative, for example. We want to make sure you stay informed and compliant. Writing business indefinitely is really key to me. The one fear I always have, if something happens, we run out of lenders, we don't have introducers, because then I'm not writing any business. So a little bit about how we help people. This, again, I'm going to start cutting these slides fairly soon, but this is a little bit about what, when it came to GDPR, what the ICO did. First of all, they issued something in 2019 that was 318 pages long. I got as far as page 5 and then gave up the will to live because it was just written by somebody who probably just left, was a speechwriter at the FCA possibly. It was unreadable. So that's what they produce. This is what we produce. Quite simply, we came out all the way back in 2018, a GDPR checklist, which I copied and pasted from the ICO website. Why on earth they didn't think of doing this themselves, I have no idea. But I copied and pasted it into a document, completed it myself, and then thought, what a great idea to give these out our mortgage shows, which we've done ever since. So if you've got this on your email today, if you've not seen this before, and you've not done anything regarding GDPR, because if something did go wrong and you couldn't show that you've actually tried to adhere to what's going on or you've done any work on it, they potentially could shut you down. That's the FCA and the ICO. So if you have not done anything before, just complete that, tick the boxes, sign it, date it, scan it, and then file it away somewhere. And that's job done. Then we also introduced this. Again, the ICO came up with this on their website. I just copied and pasted it. This is an annual assessment, half the size of the other one. Couldn't tell you what one question is within it. I just complete it once a year, tick all the boxes, job done. I'm compliant with GDPR as far as anyone's concerned. If I was to get hacked, the first thing that will happen is the ICO and the FCA will say, what measures have you taken to ensure that you should have been safe? They will ask for proof. If it's not written down, it didn't happen. You know what the regulators are like. Some good come from GDPR, not a lot, but there is some good, because for years lenders have been nicking business from us. The worst examples I've seen before is a lender phoning up my clients on the day of completion and saying to them, next time you want to borrow money, come to us direct and you won't have to pay a broker fee. That was one. We've had other situations that have been absolutely disgraceful, but lenders were getting away with it. They don't get away with it now, or shouldn't be getting away with it now, because we've taken steps to ensure it doesn't happen. So to stop them contacting your clients behind your back, just ensure your clients, with their permission, do not opt into marketing permission. You know what clients are like. They will send them out the lender's documentation in regards to GDPR, and they'll just send it back signed and leave it blank. I've known lenders to actually then tick boxes opting in to GDPR. That's how desperate they are to market their products post completion. So all you do, quite simply, we just ensure, with the client's permission, we write across it so that it can't be tampered with, no marketing contact. Because if you don't, this could happen. Now, this was a client prior to GDPR. We weren't at that stage doing anything, because then obviously the rules were different. This was one of our lenders who, and we've had numerous examples of these since June 2020, where they contact our clients, offer them a further advance, complete the further advance, pay us nothing at all, of course, but then stupidly they advise us that they've done it. So, and as you can see, broker commission 0, broker fee 0. That means that you and I are potentially losing income, and that's wrong. So that's what we now do, and it seems to work. I always like to put this in because we are regulated under GDPR by the Information Commissioner's Office, who come down like a ton of bricks on any organisation that gets hacked. Of course, they don't tell anybody because there's very little online about this now, but they themselves were hacked in 2018. So if you went on their website in early 2018, and their website was spreading malware to mine for Bitcoin, using up your computer's power to mine for Bitcoin. Was it publicised? Did anyone lose their job? Of course not. Absolutely not. It's a regulator. That doesn't happen. And this is the shameful. This we come across earlier on this year. If you want some free data, guess what? You actually get it from the Information Commissioner's Office. Just go on their website, because you can download the entire database of every organisation and person that is registered with the ICO, all 1,048,000 of them, That is available for download. So you can imagine any hackers that think, okay, we could pretend to be the ICO. We've now got access to 80,000 emails, because there's only 80,000 emails showing up, but it's the addresses as well. We could potentially do some damage here on the ICO, giving them a helping hand. Why on earth is that available? I really cannot see any reason whatsoever why the ICO would make that available, but they do. Just ridiculous. So when somebody does get hacked, and it turns out that it was because the ICO had published all these details, guess who's going to be to blame? It will be the company that gets hacked. It won't be the ICO. So what we can offer you, I'm just going to take a little drink. I seem to have developed a cough this morning, which it's slightly worrying because one of my staff has just gone down with COVID at the weekend. So I might be testing myself after we finish today. So a little bit about what we can offer you. This is our product range. The only type of business that we do not do is equity release. It's not a market that I'm comfortable with, so I've therefore left that to those that are comfortable with it. It's something that very much, I mean, we're very traditional in what we do: regulated mortgages, commercial, buy-to-let seconds, bridging, regulated second charges. It's what we've got the experience in. There's no point me saying I'm an expert in equity release when I've only just started doing it five minutes ago. This is stuff that I've been doing and my staff have been doing for years and years and years. And our service is either packaged, you give the advice, or introduced only, we give the advice. Very simple. My staff are experienced enough to cater for both. I know there's some packages out there that are branched out into the advice arena. It's very, very different giving advice to somebody that is packaging a case. And to have staff that are able to do both is absolutely invaluable. And why are we different? Not the products we offer. We offer exactly the same as everybody else, pretty much. We've got the occasional exclusive. We've got a lender presenting next month where we've got 3 totally exclusive products that they're offering, which we're putting out to market, and 3 great products. But most of the time, it's the same as everybody else. It's not the products we offer, it's the people we employ. Quite simply, minimum, before they even get in for an interview, minimum 5 years specialist financial services experience, not 5 years working behind the counter nationwide. It's 5 years doing what we do. That is a given before they can even get through the door. I have staff that speak numerous languages. I've got one lady that speaks 6 languages. As you can already tell, I can barely speak one. Absolutely invaluable when we come across a client who speaks one of those languages and their English isn't too good, because we can just help to explain exactly what they're taking on, and it just helps gets the cases through, makes the clients more comfortable. The most important one, there's reason it's underlined, is mature with life experience. Absolutely vital. You don't want to be speaking to somebody in my office who's been in the business for 5 minutes and has just left university, because they speak a different language. I know my son's out of university. I've been working for 2 years. He still speaks a different language. It's not something that I want. I don't want that level of responsibility of having people who might not know what they're talking about. We did mistakenly employ somebody a few, 4 years ago, probably 4 years ago, who just finished university. I just brought her on as a junior. On her first day, explained what her duties were, one of which was answering the telephone, and a look of horror on her face when I said she'd have to answer the telephone. She'd never actually picked up a telephone that had a cord on it, and had an absolute fear of doing so. So you can imagine, I'm asking her to answer the phone just to help out the staff and distribute calls, and she was absolutely petrified of doing so. That didn't work out, as you can imagine. A little bit of feedback. This was given to me. Now, this particular introducer partner, he's probably in his 70s now. He's been in the industry many, many, many years, mainly as a mortgage broker, and he did a little bit of IFA work as well in the past. And every time I speak to him, he's absolutely glowing about my staff. And this was the most recent. This was in July. I spoke to him the other day, exactly the same again. Every member of your staff I speak to is incredibly knowledgeable, polite, and looks to find the best deal for my client. You can tell they've been working in our industry for a long time, and they really know their stuff. Every client I have passed over to your company has raved about them. I can't really say a lot more. And that's the feedback we get from people, from business partners. Don't want to call you introducers, business partners. In that our staff, or my staff, do know what they're doing, and they are a joy to deal with. Why are we different? Our lender relationships. I'm going to come on to some examples in that in a little while, but of the lenders that are presented today, I'm with 3 of them. I know their managing directors incredibly well. 2 of them, I'm in a situation. One of them was invited to my wedding all those years ago. I didn't know Marie in those days, but if I did, she probably would be now if I was remarrying. Don't tell my wife. But that's the type of situation. But I've grown up with people in the industry over the last 38 years, but especially the last 35, who have started off as BDMs, underwriters, and now sitting as CEOs of some fairly significant lenders. So I have a different type of relationship to many out there. And it's not just a relationship that's based on seeing somebody in the wards do and, you know, getting sloshed together. It's actually a relationship that goes a lot deeper than that. It's how seriously we take compliance. Absolutely vital. I don't want to be closed down by the FCA or anybody else because we just thought compliance was just something that we just, you know, don't really have to take any notice of. We take it very seriously. Prevention of financial crime, we don't get a lot of it, but when we do deal with it. It's a shame the courts don't, and it's a shame now actually the police aren't particularly bothered either, because we did have 3 last year, people trying to commit fraud on mortgages, reporting them all to Action Fraud, and on each one we just got an email back saying we're not looking to pursue this. So of course they probably got away with it with somebody else because who wouldn't have caught them. And it's not on numerous awards from the financial press. And Michael made the comment earlier on that you never complete any nominations. I do occasionally vote for lenders if the awards do is coming up, if it's a lender that I think has actually made a difference to the industry. Where I really have a problem is the awards for brokers that are out there, because it is an absolute farce. It really is. Here's one example. This was a Facebook post from one of my competitors. As you can see, it's been fairly recent, saying to all his Facebook friends, vote for me, and one of you, just let me know you voted for me, and one of you will win a 250 quid Amazon voucher. Not one of those people's ever borrowed money through him. They're all his mates. So how is that fair that somebody's winning an award because everyone on social media has voted for his company? It's not. It's an absolute joke. But he then prays around, I've won all these awards, I must be the best in the business. Possibly he is. I don't know. I've never borrowed money from him. I never will do. But it's wrong the way it's done. And just also some of the stuff I've seen in the past where companies that we had one where the best newcomer award was given to a company that hadn't even started trading yet, but had spent booked £20,000 worth of advertising with that particular entity that was organising the awards. Read into that what you will. I know what I read into it. So what else can we offer? Designated underwriters from start to finish. Commission paid immediately on loan completion. That's the only time you'll deal with anybody else on the deal, unless of course holidays or sickness occur, but that's not particularly frequent. So on the day of completion, you'll get an email from me, or email from the staff first of all, saying, please can we have your bank details? We always ask for bank details. You wouldn't believe how many people change their bank and don't tell us. So we always ask for confirmation of the bank, and we pay it on immediate loan completion. No excuses. Unless there's a major problem with the UK banking system and we can't make payments online, you will be paid on the day of completion, irrespective of what the situation is. In the last 4 years, I've renewed my wedding vows in Spain. I paid brokers on the day that I was renewing my wedding vows, one of which got paid after I said I do. Again, I paid brokers on the day my daughter got married, one of which was between her saying I do and me giving my speech. And last year I paid one broker just after I came around from an operation. Luckily, I didn't pay him too much or too little. I actually paid him the right amount. I wasn't allowed to enter into any financial transactions whilst I was under the morphine, but I still paid him when I felt I was actually able to do so. Still got paid on the day of completion, and no commission clawbacks as long as it's not fraud, and as long as the customer doesn't cancel the contract within, normally they've got with some lenders 14 days. Other than that, no commission clawbacks. The other thing we can offer is that, and every client, with the client's permission, of course, once we've got the client's permission, we will do an Equifax or experience search on day one for the lender we feel that the case will be going with, because we've all had situations before. I know you can ask the client to provide stuff. We're not clients alike sometimes, but we've all had situations before where a client has just lied through their teeth. My worst one I ever saw was a client I spoke to. Any CCJs or defaults in the last 6 years? No, of course not. I'm a multi-millionaire, was his response to me. We searched him and he had a CCJ for £12.5 million 3 months previously. Now you can imagine if we hadn't done that, we could have gone so far down the line with that client only to find out that he was trying to hide a £12.5 million CCJ. So we do a soft search right at the outset, our own expense. It's far cheaper for me to spend £4 on a search than it is for one of my staff to spend 6 working hours on a case, only to find out that the client either didn't know what his credit report was like, or has just lied through their teeth. But we do this. This just means we're going down the right road right from the outset. We're not wasting time approaching the wrong lenders because of what our client has told us. What else can we offer now? This is especially relevant actually with Lendco being our last speaker. So this is a great example. I wasn't happy with what I was seeing within the sourcing software for the specialist products back in 2000, or even earlier than that, but especially 2016 when second charges became regulated by the FCA. So we could see what the sourcing systems were doing, and one of the sourcing systems was missing 60% of the products in the market. So we decided to actually develop our own, which we've done. It works incredibly well. It's updated on a daily basis. If a lender, I know one lender's actually changed their rates whilst I've been speaking today. That will be this afternoon. Our system will be upgraded to their new products. It is as up to date as you can literally get. Quite often it's within 20 minutes of getting product updates. So that's on second charges, which is a loan quote. That also quotes on buy-to-let second charges. Commercial quote goes back a little bit further. We started doing that back in 2013 because there was nothing to quote for the likes of Shorebrook, Interbay, I'm trying to think what else was there, Aldermore and the like at the time. So we developed our own quoting system, called it Commercial Quote. It just means that if you phone one of my staff and say, I've got this client, these are his details, approximately what would he be paying, what would the rate be, we can tell you within 45 seconds, quite literally that quickly. And we then, when we saw how much time that saved the staff, we then developed a bridge quote, which is on the bridging side. So every lender or the two lenders you've seen today, plus a large number of other lenders are on our sourcing system, which means we can compare immediately. And I did speak to somebody yesterday who's now joined a lender from a packager, and I was talking about bridging, and he said, yeah, my old company, we did have a quoting system for bridging, but it wasn't worth. He did say the paper it was written on. I hope it wasn't on paper, but he said it was absolutely useless. Ours works. I can't emphasize that enough. It really does work, and we've got within all our quoting systems, we've built in tolerances just to capture those deals that may be slightly outside terms, where it needs a phone call. Data security. My IT people tell me no one's getting into our system and nicking our data. It can't be done. And we offer full training, virtual or face-to-face, free of charge. If it's face-to-face, I've probably got a limit of how far I travel these days. So if you're in Newcastle, it'll have to be face-to-face. If you're in Watford, more than happy to travel down. But just give us a call. Can offer whatever you need, any product ranges you need, any lenders. We can get lenders involved, do anything of that nature, anything you need. Second charge panel, as you can see, it's literally everybody. We've got new lenders coming into the market. You'll see there's one there for Scroll Finance on the right-hand side, which has actually been set up by the former MD of Paragon Second Charges. And you can see from some of the others there, we deal with everybody, quite simply, everybody that's in the marketplace. As you'd expect, I've been in the second charge market, the commercial market, since 1983. So that's basically where we are. We're one of the first brokers that lenders approach when they're entering the second charge market because of our reputation. Our packaged regulated first charge panel. At this moment in time, we've got Family, which is proven to be very, very popular. Family Building Society, obviously Precise and Together. We have Packager Status, Market Harborough, which was incredibly difficult to get on the panel. I've got some great products. And then for the smaller types of first charges, Central Trust and Norton, again, we have Packager Status with all of these. For our specialist buy-to-let panel, I'm not going to list out all those. There are a lot more. We do, if we have direct clients, for example, we can go to TMW and the like. There's no point offering those lenders to you guys because you've got access to them yourselves. But there are some lenders on there you would find difficult to get on their panels, and that basically pretty much covers the whole of the market. Now, if you wish to give the advice, this is what we now have. So fairly substantial, as you can see. What is that? 4, 8, 12, 15 lenders on the buy-to-let side where we can package on your behalf, and you would get what you would get if you went directly. So if you've not used this before on the packaging side, give us a go. Our specialist package panel, all of these 7 lenders will shortly be appearing on Mortgage Brain. Actually, they're already on Mortgage Brain. 27 Tech, we're about to sign the paperwork for all of these to go live. And Trigold, we're just trying to knock them down on price a little bit because they're just a tad expensive, but that will be going live as well. So you can access all of these. If you are searching for these, you're looking to go for a packager, just look for either Specialist Hub or 0% fee Specialist Hub, and then whatever the lender's name is. Quite simply because we are not charging any packager fees on those 7 lenders, either upfront or on completion. And this is from Mortgage Brain that we took from Mortgage Brain. I think it was just before Christmas. As you can see, if you go somewhere else, your client could be paying anything up to 300 quid. With us, it's not a penny. If it doesn't go through, it doesn't go through. But that's the service we offer. There's no one cheaper. Bridging panel, there are more on our panel than I can't fit too many lenders on there. So every single one of those lenders and more are on our panel, and we have packager status with almost all of those lenders. So again, you would get the same from us as if you went direct, but of course you've got the expertise that we have within bridging in the background to help you with that case. Our commercial panel, pretty much everyone you'd expect. Some are very, very difficult to get on board with. Yorkshire Building Society, or Yorkshire Commercial Mortgages as the department is called, incredibly difficult. It's more difficult getting an agency through them than it was actually getting FCA authorization, seriously. Allica, big part of our business now. The high street, as you would expect, and of course just some other lenders there. You think, who the hell are they? It literally covers every single scenario you can think of. If you wish to advise on second charges, something that Marie touched on earlier, quite simply, you can do so, and we do not charge any packager fees, again, up front or on completion. You give the advice, you choose what the fee is going to be. So if you want to earn 5 grand from it, you can earn 5 grand from it. If you want to earn 395 quid from it, you earn 395 quid from it. For the larger deals, we also give away part of the prop fee as well. But we will instruct the valuations for you. We'll apply for the consent if it's required for you. We do all the things you might not be totally comfortable with if you were arranging a second charge loan and may not be familiar with. We do all that in the background, and we help you with the sourcing as well. We source it for you and then give you the necessary research that you can keep on your file. We do all that work for you, and we don't charge any packager fees. This is literally, I only put this slide on last night because I've only just finished this. So if you wish for me to send you over, I can send this to you as well. Just within the type your message, if you just put your name and proc, I will email this to you later on this afternoon. I've got to make just 2 little amendments on it just for it to fit properly on a PDF. There you go. Someone already has. Thank you, Katrina. I will send this over to you today. Believe me, no one is beating what we're paying, quite simply. And it covers, I think there was close on 40 lenders within that at the moment. So just let's say 2 of you have now requested it. I will get that over to you this afternoon. I'll probably do set because I know 1 or 2 of you have actually asked for all 3 things that we've mentioned today. I'll do each one of them separately, just not to confuse myself. But that's now available. Have a look, see what we pay. I've seen what everyone else is paying. And no one's beaten us. They're really not. Always beware of the bandits. I can't stress this enough. We come across it all the time. I always quote this one because it's the worst one I've seen in all the years I've been doing this pretty much. But just be really careful when you're generating, if you don't know who you're actually giving business to. A delegate at one of our physical shows in 2018 came to me actually afterwards with the paperwork on a case. 1.4 million buy-to-let portfolio, could only go through Interbay at that particular time because of the client's circumstances. And the guy who was there I was speaking to said to me, they've said that they don't receive any commissions. They're going to pay me 7 grand. They're looking to charge the client 30. And I said, well, that doesn't sound right. Where's it going? He said, Interbay. Well, Interbay have always paid a minimum of 1.5%. So that was a lie straight away. The 30 grand, they knocked down to 24.5 as a fight in final. They wouldn't go any lower. So they were going to be earning 45.5 grand from a deal and paying that introducer 7,000. That's wrong. That's absolutely wrong. We did the deal, didn't charge a fee, any fees whatsoever, split the 1.5% 50-50, both walked away with more than 10 grand. Introducer was absolutely delighted, or business partner, as I should call him, absolutely delighted. A couple of case studies. I know everyone likes to give a case study. Well, this is some of the stuff that went on last year. I do need to update this with some of the stuff that's happened this year, but quite literally just haven't had the time. But this was a great one from last year. Octane Capital, who are a regular presenter at our shows. They're one of the very few lenders that is very flexible on the rental coverage calculation. Well, this one was in Holloway in London. 3.25 million enabled the client to buy the last flat in a block that he owned, which then enabled him to take full control of the freehold as well. So it was very much in his interest to do so. He couldn't get the money anywhere else. He had been promised by another broker that he could go through Landbay, when the rental coverage even on Landbay's calculation was sitting at, I think it's about 110%. He's an individual, so Landbay actually need far, far more than that. Well, Octane did this. It was 101% rental coverage. Because of what he was earning from the rest of his portfolio, they looked at the case as a whole. And yes, this is a deal we'd look to do. Introducer rent 32.5 grand from the advance. It was actually spread across 2 days, not on all of the day of completion, because I can only pay 20 grand a day to a broker purely for security purposes. But he was absolutely delighted, as is the client, who's now offered me a very cheap kitchen because he also has a kitchen business. So hopefully I might take him up on that. But that was case study number 1. Case study number 2, again last year, Hampshire Trust Bank. We are one of, if not the largest producer of business to Hampshire Trust. 75-year-old expat living in South America for 10 years, had 1 property in the UK. I don't think he'd ever lived in it, but just the 1 property. Needed some money for his retirement, believe it or not, and repay existing credit card debt. And on this one, we acted as packager. Introducer earned £4,394 on the day of completion. That really is outside Hampshire's criteria. As you can imagine, that was just a phone call. This is the case. This is the situation, and they were happy to do it. Number 3, approached by a client. This is just on as far as bridging is concerned. Now, if you're trying to do a bridge, for example, on a multi-unit freehold block, invariably the lender's going to want a valuation. Well, on this one, we didn't have time to get a valuation because the client had to complete before the stamp duty deadline, not just to save himself stamp duty, but it had to be done by then, otherwise it wouldn't go through at all. So normal situation, you speak to an underwriter, oh no, we need a valuation. I spoke to a directorate together and gave him the case. When I told him what the LTV was, he said, all right, I'll go on Google, see what properties are selling for. And as long as they're going for over $1 million, I'm happy to do it. Well, they actually were going for over 1.7 million. So they did that no problem at all. Again, introduced rent £3,000 on the day of completion. And this was one from Roma just before Christmas, that cost just in November 2021. I've never ever come across a deal where it's a purchase where a neighbouring property has been nicking the electric for many, many years, which was something that was discovered during the valuation process. But on this particular one, a very difficult case purely because it only had planning for a 10-bed HMO, and it's been purchased with 20 bedrooms, many of which were undersized. So under the 30 square meters. Actually, in fact, they were actually under the minimum HMO requirements as well. They were tiny, some of these rooms. So we arranged 10-month bridge, introduced rent £21,000 on the day of completion. Again, just managing director of that particular firm I know very well. It was a situation slightly outside criteria. A phone call was made and they were prepared to do it. And I always finish our testimonials on it's not what you know, it's who you know. Forgive me if you've heard this before, but I'll be dining out on this until the day I die, probably. Husband and wife business, 2 very profitable children's nurseries. Mr. run the financial side. He was also an airline pilot as well. So he ran the financial side on the side. She ran the kids' nurseries. She did that part of it. Mr. had defrauded HMRC out of £850,000 over, I think it was well over a decade. Was eventually caught, sentenced to 5 years in prison. She divorced him. But all the assets in Mr's name, including their home, including both kids' nurseries and a couple of buy-to-lets, was subject to a Proceeds of Crime Act charge. So every lender that was then approached, Barclays called in the commercial mortgages, Northern Rock residential mortgage of an overturn, and lenders were then calling in these mortgages. Barclays wanted their money back. Reputational risk was the reason. And that was the same answer from every lender that was being approached through multiple brokers. Came to us. We went through the same procedure to start with, reputational risk. Sorry, we can't help. So what did we do? We approached together. It went through their underwriter, approached their compliance department. No, sorry, that's reputational risk. We can't help. And the case was then given to me to sign off as a decline. And I thought, there's a deal to be done here. They've got £300,000 sitting in their business account. This is a very profitable business. And she's being punished for something that has nothing to do with her. So he was being taken off, obviously, because he was in prison. Taken off the titles of the properties. So I contacted, again, directorate together, who I've known for many, many, many years. I explained the deal to him. Very, very different when a director goes into compliance department and says, why aren't we doing this deal? Than it is to an underwriter going, I'd like to do this deal. 10 minutes later, came back to me, yeah, that's no problem at all. Case went through, introducer earned, just on that part of it, just under £12,000 on the day of completion, on a case that had been turned down by everybody. Literally everybody. And I could give you other examples, but that to me is probably, just in a nutshell, it's not what you know, it's who you know. So important in what we do. And this particular broker who introduced this, I've taken out a couple of bits of this because he did want to remain anonymous, but I've underlined the main part of it. The service you and your team provided and continue to provide is second to none and well beating. He did offer to take all the staff out for dinner, but I thought that probably was a step too far. It'd have to go in the book of what they call it, the inducements book. So I declined on that. But obviously he's absolutely delighted, and they've now got a repeat client who's coming back to us now for more buy-to-lets, because all the proceeds of Crime Act charges, once they were repaid, she could go back to the mainstream. So everyone was happy. Cases you can't place. Anything you can't place, there's various ways you can give us business. Obviously, just type your name in the bottom if you've got something you want us to give you a call back on. DIP forms will be sent to you this afternoon. Complete one of those. Go to our website and complete online, specialisthub.co.uk, or just go old school, pick up the phone, speak to my team. They're waiting on your call. I have got one person currently working at home with COVID. So if you do speak to her, please do forgive her coughing fits that she's currently having, but she's working away, beavering away, getting her work done. That's what my staff are like. Who to contact? On the regulated side, my two heads of department, we have Kate Martin and Kirsty Riley. It's Kirsty that's currently got COVID, so be gentle if you speak to her. Kirsty's been with me since 1997. Kate's experience goes back to, I believe it's about 2006, 2007. I can't much remember now, but it's a lot. I mean, there's not a lot that these two do not know about first, second, and regulated bridging. And they know a lot more than I do, believe me. If it's on the unregulated side, so commercial, buy-to-let, and non-regulated bridging, we have Joe, Haley, and Sakina. Sakina's my 6 languages speaker. Give them a call, and they're more than happy to help with any inquiries you may have. You should have received something from me if you're on LinkedIn and we could find you. If your name's John Smith, it's always very difficult to find somebody, but if we have found you, would have had a request from me. Please accept it. We can then keep you updated. But it's always great to keep in touch on LinkedIn, because you can see details for future shows. And also, if there's any products that we come out with, we will post on LinkedIn as well, if there's any specialist products. So please link with me on LinkedIn. You will be sent this today with the broker pack, which you'll see a copy of in the moment. Agency application. Don't need this to actually receive cases from you, but I do need it to pay you commission. So that's the only time I wouldn't pay somebody on day completion, if they've not actually signed an agency agreement, because we do need one of those back. It's the rules, unfortunately. And this is what you'll receive. No, actually, no, I've taken that slide out of the broker pack, so it had my name on it and people were getting confused. Next mortgage web show, 7th of April. As you can see, we have Castle Trust, Yorkshire Bank, Yorkshire Building Society Commercial Mortgages. I've got their name was for a moment. Shawbrook Bank, and Together's guy hasn't sent us his photo over yet. He sent us a photo of him and his entire team. We didn't know which one he was, so we're just waiting on that to come over and also tell us what he's going to be talking about. But again, varied across all different products. So please, if you can attend as many of our shows as you like. They're obviously all free, and they're free for lenders as well. That's why they're so popular with lenders to present at, and that's why we have a waiting list, because we don't charge them a penny, because these are very cheap to put on, as you can imagine. Future shows after next month, it's normally the first Thursday in every month, except in June, because we've got the bank holiday now moved to a Thursday. So it's always going to be the first Thursday of every month, except for that one. So but you can attend as many as you like. And it's fairly rare for somebody to present more than twice during a year, as far as the lender's concerned. So you will see a whole cross-section of lenders, not just the ones that are prepared to pay us £1,000 to attend, like some of the financial press do, as an example. Feedback and CPD, I already mentioned this earlier on. When you leave today, the event board button in the top right corner, if you click on that and then click the exit event box, your feedback form will then appear straight away. Please complete. It's absolutely vital for us to get these back, to see what we're doing well, see what we're not doing so well. Your CPD certificate will be emailed shortly afterwards. Don't bother. You don't need to put your name in the message box below, because we've now sorted out the issues, but about 10% of these don't go through. So if you've not got it by, say, tomorrow afternoon, just pop me an email. You've got my email because I've emailed you today. Pop me an email and I'll ensure my IT team send it out to you manually. Some feedback. As a thank you for today, I'm much appreciated if you could either just go onto Google or Trustpilot and leave us a review. Please don't go to Specialists Hub, which is a training company that's set up during lockdown, which I believe has now gone bust. But the Trustpilot is still live for some reason. Just if you can go on those and just leave us a review, that'd be very, very much appreciated. And that's it. Thank you for attending. We're 5 minutes ahead of time. Thanks for attending. Enjoy the rest of your day and the rest of your month. Until next month, stay safe and prosperous. Thank you very much for attending.